Tom, you brought up the Virginia governor race. Let's talk about that briefly.
Sure.
The president is set to go down there on Friday and campaign with Terry McAuliffe. Now, there's a question as to whether that will actually help him. Will it help him?
I think it's about turnout, John. I think Mr. McAuliffe is extremely seasoned at the domestic Virginia calculus, and it's a really interesting calculus, John, maybe centering down south on Virginia Beach, down where Dennis Gartman lives. But I would suggest, John, that Virginia is an incubator for all of the worries and fears that the Democratic Party has. And guess what, John? It's no different than Boris Johnson in your England. It's all about turnout, and it may not be there for Mr. McAuliffe.
That vote taking place on November 3rd. Tom Keene, Lisa Brammett and Jonathan Ferro waiting for JP Morgan numbers in 20 minutes at some point this hour, sometime same place. New York, Tom, I don't know, when does it drop? When does it drop? 20 minutes? Something like that.
6:47.
Thank you, Lisa. 6:47. Futures
hey, John,
up 2
they have
cents.
Tang here.
Do they, Tom? This is Bloomberg.
Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Live from New York City for our audience worldwide, on radio, on TV. This is Bloomberg Surveillance. What a morning we've got coming up for you in about 20 minutes' time. We'll get earnings from JP Morgan, then on to CPI in America, 8:30 Eastern. Going into that, equity futures positive, 0.2% on the S&P, on the NASDAQ 100, up about 0.5% on the Russell. The small caps doing okay, up 5, advancing 0.25%. Switch on the board and get to Apple is the story of the past 24 hours. Fantastic reporting from Debbie Wu out of Taipei here at Bloomberg. That stock 140.75 and negative about 0.5%. You can learn something from the story. They've got a problem with production and can't access the chips, or you can learn something from the story and how the market responds to it. The market's not doing much here, Tom. Let's be clear about that. We're down 9.69% from the September 7th high on Apple into the close yesterday, and we're only down another 0.5%. It will raise the question. We understand this story. How much do we understand it? Is it a case of profits deferred and not profits lost? This, Tom, a case study for a much broader issue for this market deeper into earnings season.
And part of it is the consumer demand. And John, that would center right from Apple and a very successful iPhone launch based on what I've learned and how the phone companies, T-Mobile, AT&T, and Verizon, are in a massive price war like they were 10 years ago. You know what, John? That keeps the consumer going. And to me, that's a surveillance debate right now. You've got a gloom crew looking for consumer slowdown. Call that Jan Hatzius. And you got another crew looking for a consumer doing resiliently well. Maybe that's Neil Dutta.
We'll add to that debate, Tom, a little bit later. Neil Dutta, 8:30, straight after the CPI print a little bit later, so looking forward to that. Let's finish on this on the bond market. Switch on the board, 2s, 10s, and 30s. Your 10-year yield in a basis point, your 30-year yield in 3 basis points, let's call it 3, and your 2-year up a basis point, so up at the front end, down at the long end, it's a flatter curve again.
On radio, you're missing this. It's just too good.
For 2 straight sessions now, we're seeing a flatter curve. We were down 8 or 9 basis points, 2s out to 30s yesterday, and now we're down another 2, 3, 4 basis points. That curve is just a bit more flatter once again. That flatness into CPI, compelling, interesting, I think.
Yeah, I think it's raving about inflation and what's going to happen there. Gita Gopinath providing some clarity from IMF yesterday on the transitory debate of the moment.
A dirty word, Tom, according to the Atlanta Fed president.
Rock solid and decidedly not transitory has been the bank research excellence of Gerard Cassidy. I was thrilled to learn this morning he joins us here for a good amount, an ample amount of time as we await JP Morgan. We're going to do some oil here as well. But Gerard Cassidy, thank you so much for joining us right now. I want to know, in all this uproar, if these banks will adjust, change, amend their use of cash, or is it business as usual?
Thank you for having me, Tom. And I would say that they would love to put the cash to more successful uses, but it's really challenging on the loan growth side, as you know. In the flood of deposits that have been created by the Federal Reserve through its monetary policy known as quantitative easing has really dampened their ability to put this cash to work. As you guys have just talked about, the rates are quite low at the short end of the curve, and this is weighing on the banks. But this quantitative easing, as the tapering hopefully kicks in and it ends sometime in the middle of next year, that will give the banks some relief. But Tom, boy, you and I have not seen deposit growth like this in our careers.
We've not seen it there. Look at $1 trillion overnight repo. Gerard Cassidy, when you take use of cash of the internal business over to use of cash for shareholders, is it business as usual?
That part will be. In that sense, Tom, what we're seeing is that though the banks are stuffed with deposits, they're still generating significant profits. And they're able to do this because, as you might recall last year, they had to set aside billions of dollars in anticipation of credit losses that never materialized. They didn't materialize because of the successful policies by the federal government as well as the Fed in pulling us out of that deep recession in the second quarter of 2020. But that is now turning into a return of excess capital. So for shareholders, what we're seeing, Tom, for the first time since pre-financial crisis, the banks now are untethered from the Federal Reserve on what they're able to do with that excess cash in terms of returning it to shareholders. There's no restrictions as long as you don't violate your capital ratio. Prior to this quarter, however, you always needed pre-approval from the Fed for share repurchases.
Yeah.
That's no longer the case.
Well, Gerard, a lot of investors already are counting on this. And Greg Bottle yesterday, or actually earlier this morning, was talking about how he's going to look past this. He's looking for loan growth, and he's looking for expenses, as especially banks start to pay up in order to attract talent. How much are you watching their expense ratios at a time where junior analysts come in making $200,000 a year?
It's a great question. We wrote about it yesterday in a research report. Expense growth is now a new issue that is developed. It's not just a banking industry issue. We hear all throughout the economy that the cost of wages, the cost of hiring employees is higher. And this will be one of the areas there will be increased focus in the third quarter results that start today with JP Morgan. Now, the other bigger macro trends, and you touched on one, loan growth, we think will overwhelm the headwind of higher expense growth. But it wouldn't surprise me come fourth quarter results, which is in January of next year when they are released, if we start to hear about cost savings programs, because it is becoming a challenge. Negative operating leverage is now persistent throughout the top 20 banks, which was not the case a year and a half ago.
Which banks in particular, Gerard, are you particularly concerned about in terms of how much expenses are going up?
The big banks, including JP Morgan Chase and Citi, are examples of companies that have high levels of expense growth, that is, relative to revenue growth. Also, the investment banks, Goldman Sachs and Morgan Stanley. So it's going to be very interesting to see how they handle this expense rate of growth versus revenue growth over the next 6 to 12 months.
Gerard, what are we learning just in terms of a leading indicator for loan growth? Do you see anything in card spend over the last 12 months that gives you a nice subtle signal that things will pick up? What's the leading signal that you look for?
There's two areas, John. The first, and you touched on one, the card spend has started to pick up. There's monthly data, the trust data, the credit card trust data that comes out every month is a great leading indicator. The Federal Reserve data on consumer lending out of New York Fed, another good leading indicator. But number one, what we're focused on, because it's the largest loan category and it has not recovered yet, is good old-fashioned commercial lending. So what we're watching carefully is the inventory to sales ratio in this country, all-time record low. You guys have talked about the supply chain issues over the last 6 months. They're intensifying today. So as inventories are rebuilt over the next 12 months, that's going to be the key indicator to watch for commercial loan growth, and we expect that to accelerate in 2022.
Gerard, do you also see a reluctance to invest at the moment before all these supply chain issues, supply side issues get resolved? Is it difficult to build out a business if you can't access labor? Is it difficult to make those investments right now?
It certainly has its challenges, John, no doubt about it. But as demand starts to accelerate, you look at some of the capital expenditure numbers depending upon the industry, and they're certainly very healthy and robust. But it is a challenge because of labor and also now because of the supply issues with the supply chain. But as the COVID problems fade away, hopefully in the next 6 months, and it's no longer an issue, I think that's going to be the real catalyst to bring everything back to normal.
Gerard Cassidy, what are they going to do about headcount? What I see here, like in every other industry, is a solution by technology. How many jobs does technology take?
Tom, it's a really good question. And in fact, in this report we wrote about yesterday with expense growth, we were looking at the headcounts since 2008 for our major banks. And in cases of Bank America and Citigroup, they're down materially. JP Morgan, not the case. Primarily, you might remember, Tom, back in 2008, they acquired Bear Stearns as it was failing, and they picked up the failed Washington Mutual. But to your point, what we're seeing is because of the digitalization and the delivery of bank products through that channel is less of a need for people and branches, and we're seeing those shrink. It's tough to really calibrate. For every dollar of technology spending, you need 0.5 less people. That's a tough calculation to do because we just don't have the data to be able to accurately do that. Needless to say, as the digitalization increases and the penetration rates increase, you're obviously going to need fewer people in the banking group, and we expect to see a slow decline in the number of people employed in banks over the next 3 to 5 years.
Gerard, thank you, sir. Stay close. as we work our way towards those numbers. JP Morgan in the pre-market down 0.2%. Lisa, what did you say? 47, 8 minutes away.
Yeah, that's right. We've got 8 minutes. And
47.
That's the official
Was
take.
that the last time the numbers came out in the last
just my
quarter?
sense.
47. Oh, your sense is 47. That's your guess.
I mean, I took an 8-ball. I shook it, and it said 647. Thank you.
647.
Yeah.
8 minutes away. Let's work through those numbers together in about 8 minutes' time then. Your equity market looks like this. Futures are positive 6 points, up a little more than 0.1%. JP Morgan numbers coming in 7 minutes' time, according to Lisa. Jared Cassidy of RBC will respond to those numbers. I'm pleased to say I can just about see Shonali Basak at the corner of my eye. She's going to be with us too in a couple of minutes' time. Going into that, yields are lower. Your curve is flatter. Your 10-year yield down another basis point to 156.29. 30-year yields down a little bit more so. Tom, we're building to the story of yesterday. Are we starting to sense some heightened sensitivity to the inflation data in America from some Fed officials on that committee?
Yeah, we are, absolutely. John, I just want to point out, you never see me out of the corner of your eye.
I do, Tom. I mean, often I just try and shape up the body to look the other way, Tom, so I can't see you out the corner of my eye. I see you now.
Yeah, thank you. We get in a ton of reports here at Surveillance, and during IMF World Bank Weeks, we are overwhelmed reports. And then there's a slim 4 pages that hits you over the head. Fatih Birol, scheduled to be with us here with the International Energy Agency. John?
Looking forward to that, Tom, in a couple of minutes' time. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro. We're positive 6. We're up a little more than 0.1%. Big morning this morning. Good morning. We have CPI at 8:30 Eastern. And according to Lisa, JP Morgan numbers in 5 minutes and about 32 seconds.
That's correct.
This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Congressional Democrats are still divided over how to slice up President Biden's economic agenda. They are coming together over a tax and spending plan totaling about $2 trillion, down from $3.5 trillion in the original plan. But they can't agree on which parts of the president's agenda to keep and how long to pay for them. A change is coming at the Federal Reserve. Vice Chairman for Supervision, Randy Quarles, will be removed from his role as the Wall Street Bank's main watchdog after his title expires this week. Progressive groups now get to see their least favorite Fed governor sidelined. Quarles will now share oversight responsibility with 2 other governors, Lael Brainard and Michelle Baumann. Vladimir Putin sees Europe's natural gas crisis as Russia's golden opportunity. The Russian leader wants the European Union to rewrite some of the rules of its gas market after years of ignoring Moscow's concerns. Russia's also seeking rapid certification of the controversial Nord Stream 2 pipeline to Germany to boost gas deliveries. Now, China's exports have surged to a new monthly record in September. Strong demand in advance of holiday shopping season outweighed the effect of power shortages across the country. Rising prices also added to the increase. Meanwhile, China's imports rose less than expected. Michael Burry's profitable bets against the housing bubble were immortalized in The Big Short. Now, the doctor-turned-investor has gone on a Twitter rant against taxes. Burry denounced what he calls U.S. class warfare, and he challenged the notion that the rich don't pay enough taxes. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
The day that banks are completely disengaged from the fossil fuel industry will be the day that there's no more fossil fuels. But if you look at the International Energy Agency or Science-Based Target Initiative or people who have really studied this carefully, in 2050, we're still going to be producing oil and gas. Coal is more debatable, but we're definitely going to be producing oil and gas.
Fantastic interview there with Bill Winters of Standard Chartered, the CEO. Tom, it was really interesting, but I was distracted. Mr. Winters not wearing a tie over at Standard Chartered. The style shifting in London, maybe.
Yeah, well, he learned it from Hotzias at Goldman Sachs.
Perhaps,
and
Tom. Maybe Young was the leading indicator there.
Oh, my goodness. Yeah, Leon was out front and leading
Lisa,
on that.
honestly, it was the one thing I noticed. You're the CEO of Standard Chartered in the City of London, and you go in tieless.
I was focused on what he had to say.
I'm sure you were. Equity futures up 5 on the S&P.
Carry on.
We add a little bit of weight to the S&P 500, up more than 0.1%. It is a big morning. We've got JP Morgan numbers in about 3 minutes' time. We've got CPI at 8:30 Eastern time. And going into that, 156.12 is where we are on 10-year yields in a basis point or two in the commodity market. And we talk about crude in just a moment, Tom. $80.16. We're negative there, 0.6%.
Let's review that right now, and certainly the view from Washington, John, is very different than what you and I hear in New York or in London. We quote West Texas Intermediate. We quote Brent Crude. Down here, John, they quote one thing. What's a gallon of gas? And they don't care what it costs in Italy or the United Kingdom.
So we've got a case study for this coming up, haven't we, Tom? In Virginia, the governor race. Do you think that's an indication of a broader story across this country right now, or does it just speak to local Virginia politics?
No, I think I think it's much more than that. There is a national tinge to the Virginia race, as Anne Marie Horton talked about, with the turnout, and as Karen Tumulty says in the Washington Post today, on will women turn out as they did anti-Trump a number of months ago. But John, what's really important here is the oil is much more from sea to shining sea, and it's much more a Republican issue because those are Republican states.
We need to do a couple of things this morning, Tom. We need to talk about the energy market in just a moment. JP Morgan out in around about a minute's time. When those numbers break, we'll bring them to you. Sonali Basak will break it down with us as well. And then we'll get to Gerard Cassidy of RBC. Going into it, JP Morgan shaping up as follows. Just a little bit negative, but a big rally off the lows of September 22nd. The why? A conversation about the Federal Reserve, a conversation about the prospect of higher interest rates, and a pickup in the KBW Banks Index off the back of that. So we're rallying hard into bank earnings. JP Morgan down 0.2%. Bank of America on the session of the pre-market up 0.3. Citigroup up 1/3% as well. Those numbers imminent. I want to talk about Apple too. Switch up the board and get to Apple pre-market. This one for me, just capturing earnings season almost perfectly. And this isn't the earnings of Apple yet. Lisa, we finally got a warning from Apple from our reporting that maybe they've got supply chain issues too. JP Morgan numbers drop. Here they are. Third quarter EPS $3.74. Adjusted revenue $30.44 billion. The estimate $29.86. Managed net interest income $13.18 billion. The estimate there $13.19 billion. The credit cost net benefit of $1.5 billion included. We're going to go through a ton of numbers here. This is what happens with bank earnings. You rattle through a load of numbers, and then you've got to start telling a story. Sonali Basak's going to be going through those numbers right now. She's going to tell us a story in just a moment. So allow me to go through them once again. Third quarter investment banking revenue, $3.03 billion. The estimate, $2.65 billion. That was expected to be strong. It's better than expected. Overall EPS $3.74. Adjusted revenue $30.44 billion. The estimate $29.86 billion. So to add to this, Sonali, those numbers just drop in. A whole lot more still to come. What do you see so far?
We're seeing that they are blowing past estimates, and part of that comes from much stronger than expected investment banking earnings. You have fixed sales and trading revenue just about flat, just about in line with their expected, a little bit short, John. But the comparison that we're making is also from 2 years ago, before all of the pandemic havoc had wreaked these businesses, and they are just about in line with where they were about 2 years ago. That investment banking revenue, again, coming in way past estimates, shows you that the bank is firing on all cylinders. And so it is still important that even as trading moderates, to keep an eye on both of these businesses. They did have some reserve releases as well this quarter that would have helped down to the bottom line. But with that said, again, Jamie Dimon has guided that loans are growing. Net interest income is in line with expectations. The question is, can that continue, and are they going to guide stability towards the end of the year?
Sonali, thank you. Stay close. I want to get a final comment from you in just a moment. Tom, those trading numbers, fixed sales and trading revenue for the third quarter, $3.67 billion, the estimate $3.7, just shy of the estimate, no big deal here. Then you look at equities and sales trading revenue, Tom, $2.6 billion, the estimate $2.17 billion. FICC was expected to be soft because of the year-over-year comps here, Tom. They were difficult. But if you look at equities, they were expected to be strong, and they skip over that bar. $2.6 billion, the estimate, Tom, $2.17.
John, what is so important to me is the opening comments from Mr. Dimon as these important numbers are released. And it's not about numbers. It's about a $2 billion plus release of credit reserve. This is Jamie Dimon saying everything's fine. We're doing great. We're improving forward, and we're going to release rainy day money for another time when we had to take a loss. We don't have to take a loss, and we can show that money. He leads with the release of credit reserves.
The economic outlook continues to improve. Gerard Cassidy with us now from RBC Capital Markets. Gerard, you've had a couple of minutes to pour through this. Jamie Dimon, the CEO, saying the economic outlook continues to improve. I think this is the third quarter of a big reserve release. What sticks out for you?
In fact, John, that's the number one issue for not just JP Morgan, but the industry. As we were talking a few moments ago, last year, the group built up these reserves in anticipation of large credit losses, which never materialized. And to Jamie Dimon's point, as the economy strengthens, credit's only getting better. And as a result, the reserves that have been set aside need to be brought back into income. Moving over, though, to the capital markets businesses, as you pointed out, the investment banking numbers are strong. I'm assuming the advisory numbers in particular were strong, as well as ECM. And that equity trading number, as you highlighted, very strong. FICC was in line. So from the first read, these numbers look quite good. Looks good for the other players in the business: Goldman, Morgan Stanley, Bank of America, Citigroup.
Gerard, you're gracious with your time. I know you've got clients to call, but if you had to ask a question a little bit later on the analyst call, what would it be right now?
I guess the number one question is going to be, how are they handling the supplementary leverage ratio? That's the ratio that's now their binding constraint. That's the one that they've got to be very careful of. So that talking about capital and how they're going to manage capital is the key question.
Gerard, thank you, sir. I know you've got to run. Got to keep it short for you. Gerard Cassidy there of RBC. Lisa, that stock, 165.96, positive about a third of 1%. There are some beats in there, but a lot of this largely known, recognized going into the numbers.
The idea, though, that they weren't hampered dramatically by lower yields and by the fact that they are positive pretty much across the board, particularly with equity trading, giving them a lift. A key question we haven't talked about, John, and I know we have to get to our esteemed guest next. Key question to me is, what's the regulatory risk with Randy Quarles stepping down from his vice chair of supervision role and Lael Brainerd potentially coming in and having more influence? Does that matter at all on these levels?
You say potentially. Are we getting a decision on that anytime soon?
Not with respect to the Fed chair, but with respect to having more guidance for the supervision role. She is going to have more of a role on the interim basis, at least, without a chair position.
The quarterly numbers from JP Morgan behind us, still ahead of us. A ton of earnings coming up tomorrow, then on to Goldman Sachs on Friday. JP Morgan positive by about 0.5% to 166. We're going to stay on this story through the next couple of hours on Bloomberg TV and radio. We had some technical difficulties with Fatih Birol a little bit earlier this hour. I understand we can catch up with him right now, the International Energy Agency Executive Director. Fatih, forgive me, we've got to cut this short because we had some technical difficulties with you, but let's start right here. The energy transition is increasingly difficult right now worldwide because consumers are starting to see higher prices of fossil fuels. How compromised is that transition at the moment, sir?
Thank you. I think there might be a misunderstanding, or some people are trying to portray it in a way as if the current market crisis is the first crisis of the clean energy transitions, and the current situation with natural gas or oil or coal, it has nothing to do with the clean energy transitions. There are different fundamental drivers for that, and in my view, clean energy is not the cause, but the solution to this problem we have. So therefore, it is important to put this in a perspective. And the price of oil, you were just talking about a few minutes ago, today it is above $80. But today the world consumes about 96 million barrels per day. And only 2019, the world was consuming much higher, 100 million barrels per day of oil, and the price was $60. So we cannot talk about the lack of investment to oil or other things. There is enough oil in the world, but the high oil prices must be a result of other things rather than the lack of capacity or lack of investments.
Fatih, as a representative both of the energy industry as well as a proponent of the transition to a cleaner energy future, do you think the price of oil should stay high, should go even higher to expedite the transition period?
I think the current prices, oil, gas, coal prices are a serious challenge for the global economic recovery through higher inflation. And as such, those prices I would like to see as lower than they are now. But regardless of the prices, clean energy is coming very strongly. It is the electric cars, it is the solar, it is the wind. Just today, I just saw the electric car sales in China, the largest car manufacturers. It is more than 20% of all the cars sold in China are electric cars. Same in Europe. It is going to grow, and it will end up, I expect, a big impact on the oil demand. We shouldn't be fixated what is happening today in the markets as a result of the unsustainable economic recovery around the world. Let's look at a bit beyond this, and I expect that the current climate policies of many governments, from China to United States to Europe and others, will have significant implications for the global energy markets.
Fatih, we have to leave it there. We had to cut it short for some technical difficulties. Fanny, please come back soon. We'll have a longer conversation on an important topic. Fanny Birol there, the IEA Executive Director. We need to come back and recap what's happening with JP Morgan and set the scene for you for earnings season through the next week or so for the big banks on Wall Street. JP Morgan largely in line, some beats out there. Equities trading holding up nicely. The stock unchanged at 165.40. Shanali Bassett will be back with us in just a moment. We'll recap those numbers for you. Then it's the march towards CPI in America at 8:30 Eastern Time. The week starts right now and it gets busier and busier and busier. Futures up 7, advancing 0.2% from New York and DC this morning on radio and on TV. This is Bloomberg.
They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's a difficult market to navigate right at the moment because you do have this sort of stagflation narrative.
This right now, we're seeing narratives that are completely new to us.
Households are still flush with cash, and businesses are flush with cash.
This conversation around slower retail sentiment, slower retail sales, very much is feeding into why inflation eventually will come off.
If your sort of question is simply, is growth going to slow next year? The answer to that is a resounding yes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Earnings season is underway. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your equity market positive 5 on the S&P, up a little more than 1/10%. Tom Keene, JP Morgan, first out of the gate.
I think it's a huge deal, John. I think it's being underplayed. Everybody looks at the stock price and says, so what? Here's the so what. They are doing fine. And I thought James Dimon's opening salvo, we'll talk to Shanali about it in a moment, their release of reserve credit losses is superb. It is an absolutely constructive signal about the view forward. Forget the gloom.
If you had a headline, Lisa, it's a simple one. Things are improving. Yeah. They're getting better.
Things are improving. However, there is another headline that's underneath some of the numbers, and that is lending. Average lending going up, but this is being driven by the corporations, not the consumers. You're still not seeing the consumer loan growth. And to me, that indicates this question mark around how much resilience there will be at the time when they're flush with cash.
Let's pull through the price action, shall we? The equity market not doing much off the back of this. Equity futures look like this on the S&P, advancing 5 points on the S&P 500, up a little more than 1/10%. Next stop for this morning, 8:30 Eastern time, with CPI in America going into that, yields lower by a basis point or two to 156.12 on 10s. To recap JP Morgan numbers, let's touch base with Bloomberg Shanali Basak. Shanali, equity sales trading revenue better year over year. Year over year, the comps for fixed sales trading revenue really quite tough. Just run us through the headlines.
Very tough in fixed income, and it sets the bar for the rest of the banks. We know that JP Morgan is the leader in the fixed income business. Let's move over to equities, though, because that is a place that JP Morgan has been nipping at Morgan Stanley's heels. In the wake of Archegos especially, we've seen consolidation among the big banks and an attempt to gain even more share. And you're seeing JP Morgan pull in more equities revenue than analysts even expected at Goldman Sachs and Morgan Stanley. Again, sets the bar very, very high for the other two large investment banks.
Shanali, what about the real economy? What about the consumer? We have the idea that loan growth is starting to show some sort of signs of life. However, consumers still are not borrowing. How big of a concern is this?
A huge concern, right? The card business is really what we've been looking out for. But when you look at the loan growth, average loans are up 5%. On the headline, that is a great number compared to last quarter where you saw it only up flat. Sorry, it was flat last quarter. But it's coming from the consumer and it's coming from the commercial businesses rather than auto loan, home loans and cards. So the outlook there, people are waiting for 2022 really for that to turn around. There is a little bit of wiggle room, Lisa. But again, at what point do people want to borrow and how much do higher rates scare them away?
Shanali, to use the cliche, it is original territory, but buried in this are charge-offs that were half as much as the gloom, and the reserve release was nothing short of lights out, and Mr. Dimon releases that. Fortress JP Morgan is intact, isn't it?
Yeah, it's intact. However, Tom, the story now is not about whether they can weather the storm anymore. The question now is whether they can make money. And they're showing those gains in investment banking, though trading is starting to moderate in their biggest business. You have lending as well. Where do they start to get the net interest income from? And what does it look like at Bank of America tomorrow? Are those numbers any better for the consumer? Those are the questions we look to. The expenses is the other part that we watch. They are creeping up just a little bit. They're a tad bit higher than Wall Street had expected, though not too much further away than what JP Morgan would be guiding for the year. It kind of falls in line to that proportion. Their returns on equity, you and I love to watch it. They blew through the roof at the end of the day, even with those higher expenses expenses, and even with some of those revenue businesses lines kind of moderating there.
Janani, thank you. Stay close. You'll be catching up with us through the morning on Bloomberg TV and radio. That stock 165.90, positive about 1/3 of 1%, Tom.
They lead the single line of the earnings presentation. They minted $11.7 billion in 90 days.
It's not bad, is it,
profitable.
Tom? I think they're doing okay.
Yeah, I'm sorry. The media loses scale of the massive size of this. Shanali says they're not profitable. I would use the CFA term. They're ginormously profitable.
And they've been rallying hard into earnings, Tom. Let's be clear about that. That story's been appreciated somewhat coming into these numbers. We're up by, 10% on the KBW Banks Index off September 22nd.
Yeah.
We've had a tiny
Now
run.
what?
Let's get to the now what with Jim Paulson, Luthold Group Chief Investment Strategist. Jim, let's start here. The setup for earnings, what you're focused on, the playbook through the next couple of weeks.
Well, I think, the expectation is going to be tough to keep outpacing expectations, but quite frankly, I think we came off a pretty good quarter again. When you look at hours worked last quarter, Jonathan, hours worked were 5% annualized in the quarter. If you put a little productivity on there, that's 6 to 7% real GDP growth in the quarter. So I think we're going to find out that companies still see a lot of top-line growth. They're controlling their expenses. I think they have incredible pricing flexibility on top line in general. Even though some costs are going up, their top line pricing is up to the task. So I don't really expect to see much margin erosion and pretty good top line. So I think we're going to have pretty decent overall earnings season again here. And more importantly, I think we're going to be listening to commentary, I think, from some of the CEOs as to what they say about what their thought is on transitory inflation or not. That's going to be a big item, and how long they can, fight off some of the cost pressure margin erosion.
Well, let's talk about some of that. Hopefully we hear from Jamie Dimon at JP Morgan a little bit later this morning. Let's start with Apple, Jim. Nike really set the tone coming into earnings season with these numbers that just spelled out great demand and a problem to meet it with supply. It seems, according to our reporting here at Bloomberg, Debbie Wu indicating that Apple is likely to slash its projected iPhone 13 production targets for 21 by as many as 10 million units. They can't find the chips. Now, Jim, as an investor, when you see weakness off the back of that, you've got to make a quick calculation. Is it profit lost or profit deferred? What do you think it is, Jim? Not just for that name, but for more broadly. Is there a story there?
I think it's profit deferred. That'd be my guess, Jonathan. I really do think that this recovery, there's so much growing into itself here because of what's happened. We're going to have labor growing into jobs. We're going to have supply growing into demand. We're going to have inflation that normally shows up later in a recovery. We're getting a blast of it early, and it probably moderates later. So to the extent that we have supply disruptions holding back growth now, I think that's true. But I think there's every case that means that's going to be a boost to growth next year when those supply restrictions and production is lifted.
Yeah, Jim. Well,
so when you're looking at maybe fourth quarter a week, maybe next year gets a little stronger.
Jim, excuse me for interrupting. This, though, is a really crucial point. And just to dovetail the idea of supply chain disruptions with the bank earnings, how much are banks a bellwether on the broader economy this time around versus being actually a reprieve from some of these supply chain disruptions that don't affect the banks to the same degree?
Yeah, that's a very good point. They're an industry kind of outside that realm. They've got their own issues, though. I think the bank environment is pretty darn good. I mean, they're going to have steepening yield curves here, which is already kind of going on. And they've got trading activity, which I think stays pretty strong, and deal activity, which stays pretty strong. The key is going to be, I think, which is just we're talking about, is when does lending pick up for the consumer? And I think you have to run down their deposit balances. I mean, consumers are sitting with $17.5 trillion of deposit balances, up from $13 trillion at the end of 2019. Corporations got net cash flow to GDP at 13.5%. They're almost at a record high. It was only 14%. That's the only time it's been higher. So we got to run down their savings, their deposit balances before they're going to want to step up and use credit cards and borrow again. But the capacity of the household sector, because their debt to income ratios are now as low as they've been since 1995, because their liquidity is so strong, because their net worths are so strong, there's a ton of capacity to borrow again, which we haven't had for decades. And then, of course, the banks have a lot of lending capacity. That could be an issue for 2023 and beyond, where people start using debt again.
Jim, you got to come back on Thursday, Friday, and Monday. That's the most intelligent comments I've heard on the breadth of liquidity in America in 6 months. Jim Paulson, with that said, have we lost perspective of what a boom economy is? We were addicted to 10% boom. Now we're at 4 or 5%. I would say that's a boom economy. And, you know, maybe we come down a little bit. But have we simply lost perspective on what normal is?
I think there's a really good point about that, Tom. I mean, the real issue for me as an investor in equities is, do we fall back to 2.25% real GDP growth here in this recovery, or is there going to be a sustainable premium growth rate that's left in this recovery in the balance? And if it is, I think it is, and I think if it's closer to 3% or 3.25%, that's, to your point, that is going to feel like booming growth compared to what we've done for 2 decades in this country. I think we're already seeing some of the impact of that. We're going to slow down. We're this year maybe do 6, next year maybe 4.5, and we're slow from there. Yeah. But boy, those rates are still something we haven't seen in decades, and you can see the animal spirits it starts to create in companies and consumers and laborers and investors. And I think there'll even be more of that if we do moderate inflation, if that story turns out to be transitory. Then boy, oh boy, COVID gets behind us a little bit, inflation fear gets behind us a little bit, and you're left with a premium growth rate that we haven't had. I still think there's a pretty good forward future for us here, both as a business and as an investor.
Hey, Jim, that will help the equity bulls sleep well at night, that's for sure. Jim Paulson there of Luthold Group. Jim, thank you, sir. From the optimism of Jim Paulson to the optimism of Jamie Dimon, good growth. Good growth, Tom, seems to be the line here. Tom Keene, Lisa Abramovich and Jonathan Ferro. That stock, JP Morgan, first out the gate for earnings season on Wall Street. JP Morgan up 0.8% in the pre-market. Equity futures up almost 1/10. From New York City, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. On Capitol Hill, the House has approved a short-term increase in the government's debt limit. Lawmakers are sending the legislation to President Biden just days before the Treasury was at risk of running out of borrowing authority. Still, what that means is there is likely to be another partisan confrontation over spending and debt in less than 2 months. Now, President Biden turns his focus to supply chain transportation bottlenecks today. He'll meet with corporate executives, labor leaders and port officials. The president will highlight what they've done to ease distribution backlogs. Meanwhile, the congested port of Los Angeles will announce a 24 hours a day, 7 days a week effort to confront the squeeze on goods. The European Union will offer a new round of concessions to the UK over Northern Ireland in the latest Brexit negotiations. The EU will propose cutting as much as 50% of the customs checks in Northern Ireland and up to 80% of the sanitary checks on food imports. The Northern Ireland Protocol keeps the province in the EU single market, unlike the rest of the UK. The UK wants changes in the agreement. The International Energy Agency warns that the world isn't investing enough for future energy needs. The agency says that investment in green energies, such as solar and wind, is falling short of what's needed to keep the planet from warming up. At the same time, the IEA says spending on fossil fuels is lower than needed if demand growth for oil, natural gas and coal does continue. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
田文雄君を衆議院規則第18条第2項により本院において内閣総理大臣に指名することにこの際暫時休憩いたします。
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Bloomberg surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What,
Drop
skinny
the bow
tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Hopefully it will straighten out over the next 6 months. History would show it should on a given day, and the cost of transport's gone up and the lack of drivers. If you ask our commercial clients and the transportation clients, the issue is not as much as the ships getting in, it's also getting the truck drivers to take the containers and move them forward to the next step.
Brian Moynihan of Bank of America, his numbers come tomorrow. From New York City this morning, good morning. Tom Keene, Lisa Bramett and Jonathan Ferro, your equity market +6, +7. We're up a little more than 1/10% on the S&P. Call it 0.2% higher. Into the bond market, yields unchanged now at 157.17. Euro dollar, a positive euro, stronger euro. Euro dollar 115.59. That currency pair positive 0.25%. That's the broader cross-asset story. Here's the story in the pre-market for JP Morgan, following some decent numbers, particularly in the investment banking business. That stock up by 0.6% of the pre-market on the year, up by almost 30%, more than 30%. Here's the line from Jamie Dimon, Tom. A quote, JP Morgan Chase delivering strong results as the economy continues to show good growth, despite the dampening effect of the Delta variant and supply chain disruptions on the investment banking fees, which jumped 52%. They were driven by, quote, a surge in M&A activity and our strong performance in IPOs.
I noticed buried in the statement their retail exercise, including retail in the United Kingdom and maybe a foray into digital. John, we need to put this in perspective, as if you've mentioned the bank lift of the last number of years. JP Morgan the last 10 years, 20% per year. Bank of America the last 10 years off a much more difficult base, up 21% per year. These are not single-digit stocks.
Now do Citi. See how that one works
I don't have the math in front of me. We'll do that.
That's a very different one. We
John,
can do that
you
a
had to
little
go
bit
with
later.
me. We had Brian Moynihan at the top of the block, and then now we're talking James Dimon. So I did those two banks.
I understand. I just mean, if you want a different kind of story in the mix, then on to Goldman,
I may stay
Tom,
in Washington
on Friday. Tom, if you keep going out to bars, I imagine you will be staying down in Washington.
This is the best food court of all the offices of Bloomberg worldwide, and it's because
I'm sure the hard workers here at New York, Tom, will be thrilled with that statement.
Right now, Jeff Fitzpatrick with us, and it's really special to have him here today because the distance from Lexington, Kentucky to Louisville, Kentucky is a really interesting cultural 80 miles. Jeff Fitzpatrick joins us on his Kentucky. John Yarmuth out, Democratic congressman. 5 have retired, 5 are doing other things as well. Is this a trend to come? Is this Speaker Pelosi and Senator Schumer's worst nightmare?
I don't know if it's their worst nightmare, but it is part of sort of the expectation that Democrats are getting everything done that they can. This is a last hurrah for a member who was first elected in 2006. If they can get the infrastructure bill done and their major reconciliation bill done, there's not that much left to do for someone like John Yarmuth. And part of that is the expectation that Democrats, if they don't lose the House or Senate, they're going to lose one of the two. And this is their last big chance for a major legislative victory.
Out of Yale University, he was a Republican who became a Democrat. Is what we're looking for in your world, Jack, that the Democrats, the moderate Democrats, are going to become Republicans?
This is a strange one because John Yarmuth was always fairly a liberal Republican, even early in his time in politics. He was thought by some when he first ran to be too progressive for the seat he ran when he unseated a Republican. The idea, I'm sure, that Mitch McConnell has is that someone like Joe Manchin, a real centrist Democrat, may someday want to join the Republican Party. But I wouldn't necessarily look to the Yarmuth retirement or really any other Democratic retirements as that major shift.
Meanwhile, Jack, we're talking about this with the backdrop of bank earnings, and we have to dovetail the conversation about Randy Quarles into this, the idea that he will be stepping down as vice chair of supervision at the Federal Reserve. The expectation is when he is replaced, he'll be replaced with someone who is a lot harsher on banks, perhaps Lael Brainard. What is the pressure like down in Washington to make that kind of change and exert more control, perhaps more constraints around Wall Street?
There's clearly the pressure there. The question, though, is does that win over the progressive members like Elizabeth Warren who have gone beyond that and said that there should be a change at the top with Jerome Powell? I don't think this necessarily is enough and wins over the furthest left members of the Senate. But if that's not the case, it still raises the questions about the votes for Powell being re-upped as chair. So it's probably a bit of good news for the progressives who want to see some change. Is it everything they've wanted to see? No, probably not.
But Jack, what exactly are they pointing to that they would like to see change about? This isn't an issue of the banks being perhaps riskier than they had in the past. Nobody's really accusing them of being on the brink of failure or anything even close. We're talking about them being fortresses of cash. What's the main issue here that progressives are trying to push?
Well, one of the criticisms, actually, of the progressive position is that the issues they're trying to push are not the main issue for the Fed. It's stricter regulatory issues, such as the things you've heard from Senator Warren on climate, on factoring that into banking decisions. But really, the criticism of that position is that it's not the central monetary role of the Federal Reserve. So it's the smaller stuff on the periphery in a regulatory sense that is sort of the focus for someone like Senator Warren.
Jack, thank you. We've got to leave it there. Jack Fitzpatrick down in D.C., thank you very much. Just getting some numbers on headcount out of JP Morgan. Bloomberg News doing a ton of work on this right now and putting together a couple of stories. Lisa, consumer and community banking increased its workforce 3% in the last year and added more than 1,000 employees at JP Morgan in the third quarter alone. The corporate and investment banking unit saw headcount increase 7% over the past year and added 2,000 employees in the third quarter alone. That's a big effort taking place.
That's massive. When we talk about cost increases, this is where it's coming from. They're adding staff and they're hiring with a lot more in terms of what those salaries are. How much is this a temporary lift? How much is this a more permanent shift into higher headcount for trading sales that has a more persistent footprint? This is traditionally thought of as somewhat, I don't want to use the word because it's a dirty word and I'll have to put it in the swear jar, but transitory business because it has its ups and downs.
Tom, your take?
I just don't buy the gloom. I'm going to go to Deutsche Bank, John. They love commodities. They got out of commodities. Now they got to get back into commodities.
Where's the gloom,
Every
Tom?
other... What?
I spoke.
Where's the gloom?
I spoke. There was just gloom immediately.
No,
Huge cloud just
I
rolled
just
in.
think the media is like, OMG, transitory inflation, margin pressure, and all that. And when I look at J.P. Morgan as the first thing that we've seen here, I'm sorry, it's very optimistic about solid growth forward, and that means you hire some warm bodies.
Yeah, and Tom, companies doing business. Let's be clear. One of the highlights of this report, investment banking fees jumped 52%. Companies are getting to work.
John, tangible equity was 22%. I've never framed that in my mind ever.
It's not bad, is it?
It's not like a real number.
When have we ever called you gloomy, Tom?
I'm not gloomy.
No, I don't think you are gloomy.
I love what James
talks about the
Diamond
Red
says.
Sox, although not today.
I don't think Lisa's gloomy this morning, either.
No, I'm
to
not
be honest with
gloomy.
you.
Honestly, I'm looking at this head count and I'm just thinking we always see these cycles. When the economy is good and banking is good, you see them hire a lot of people, and then we see the contractions during downturn.
By definition, that's the cycle, isn't it?
Whatever.
Lisa Bramerton,
Moving
Tom
on.
Keene, Jonathan Ferro, your equity market up 0.2% on the S&P 500.
I think J.P. Morgan needs to be cautious.
Yields in a basis point, 156.64.
Oh wait, everyone's there.
From New York City this morning, good morning. CPI in America, 1 hour and 4 minutes away. This is Bloomberg.
blackout risk, those energy prices spiking?
Well, in the first instance, we will manage it over the next while. I think the key agenda item for Ireland on the energy front is wind, and we've been great developers of onshore wind. The next decade in Ireland will be offshore wind, and we have streamlined our planning application framework for investors so they have certainty in terms of applying to invest in terms of offshore wind infrastructure in Ireland. So that will be a key agenda item of ours, and renewables. We have a very strong climate component in our government and in our government programme, and that, of course, is not disconnected from the energy agenda. And there will be challenges of that, there is no doubt, but we are making considerable progress.
Are you worried about the here and now? Are you worried about blackout risks? Are you worried about the amount of consumption data?
Data is taking up considerable demand in energy terms, but we have been robust in terms of meeting that to date.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Live from New York City on TV and radio, this is Bloomberg Surveillance for our audience worldwide. Here are equity futures for you. Positive 0.2%. The Nasdaq, positive 0.4%. The Russell, the small caps, up 1/3%. The opening bell, 2 hours away. Two stocks to look at. Switch up the board and get to them in a pre-market. The likes of Apple and JP Morgan. Romain will give you the deep dive on JP Morgan in just a moment. Here's the top line. Companies are still doing business. Advisory fees at JP Morgan in the investment bank up more than 50% year over year. Companies are getting to work. IPOs, M&A, that stock is okay. We're up 0.4%. That's JP Morgan. Apple, I have to say, that stock is okay too. We're down by 0.6% to 140.65. Tom, I mentioned this a little bit earlier in the program. It's worth repeating. You have the story, and then you have the stock reacting to the story. The latter's important. Let's start with the former. Debbie Wu out of Taiwan, Tom, talking up a cut in production targets. A cut in production targets at Apple because they can't access the chips. Okay, the stock is down by 10% from the September 7th highs coming into today. And Tom, you start to wonder how well this market is set up for that, given that we've got the news, it's clearly hitting Apple, and here's your response, we're down 0.5%.
The other news is the iPhone 13 is selling like hotcakes. Bloomberg Intelligence leading on that. They predict iPhone sales are up 6.5% above consensus, and it dovetails into JP Morgan. I'm sorry, there's all these narratives, all these worries, and the fact is Lisa and her family's lined up outside T-Mobile on the Upper West Side.
No projection.
Tom, and the issue here, if you ask the equity bulls on Apple, what are they saying? It's demand, it's profit deferred. It's not profit lost. There's a broader story for this equity market as we get deeper into earnings season. The supply side story important for CPI 8:30 Eastern as well, and this is how the bond market's set up going into it. Switch up the board, 2s, 10s, 30s, curve flatter, yields in 2 basis points on 30s, down a basis point on 10s, and up a basis point on 2s. Tom, this is how I describe the curve. It's imperfect, but it's simple. Let's just focus on a simple part of this. The long end of a yield curve is the hopes and dreams of what we can achieve in an economy, okay? The front end is whether the Federal Reserve decides to kill it or not, and how sensitive they are to those hopes and dreams, and maybe those hopes and dreams going too far. I'm talking about inflation and the sensitivity of the Federal Reserve to that inflation. So the 2-year is starting to respond to that. That's the Federal Reserve maybe, Tom. In terms of some people in this market thinking about a Federal Reserve coming in and cutting off some of those hopes and dreams for growth, and this happens on the curve.
To get 27 minutes away, 57 minutes away to inflation. John, it's a time zone difference between New York and Washington. I'm sorry.
Nothing to do with the night out last night.
57 minutes away, right. 57 minutes away to inflation. The published inflation is going to be, OMG, we're all going to die. The adults are watching Cleveland, Dallas, some of the Atlanta statistics. They're watching, yes, core CPI to come back down to where it was. The gloom crew doesn't believe that.
Tom, that trimmed mean. What direction has it been heading in recently?
A little bit elevated. Yes,
exactly.
It is a little bit elevated, no question about it.
But it starts to broaden out. We can talk about it later.
That's the fear.
10's 156.82. That's the cross-asset price action. Let's get you some movers and a deep dive on those JP Morgan numbers and say good morning to Romain. Morning, Romain.
Hey, good morning, John. Yeah, we got to start with JP Morgan. Overall, a decent quarter, $30 billion in revenue, and EPS that beat by a mile. Of course, some of that beat came because, of course, an additional release of some of those reserves here. You did see some weakness in the FIC business. Of course, that was expected, about a 20% drop here, but it was still relatively in line with estimates. Debt underwriting and investment banking fees, that was pretty much much the star of the show, and it's pretty much is what's keeping the stock afloat here, up about 0.3% here in the pre-market. We should point out the leverage ratios also look good. That Tier 1 ratio coming in at about 12.9%, that SLR right around 5.5%. So overall, relatively healthy numbers across the board, pretty much what you would expect out of Jamie Dimon and JP Morgan. The question, as always, we talk about every quarter, is whether that's going to be enough for investors. I'm sure they'll find some way to pick this apart, but right now, the stock basically unchanged, you could call it right now here in the pre-market. BlackRock is higher by about 1.6%, despite a pretty big miss with regards to net inflows. A lot of that was because of a big decline in institutional flows and fixed income flows. They did make up for some of that with regards to retail. That ETF business, that's now at $3 trillion in assets, and overall, the company's got about $9.5 trillion in assets under management, slightly lower than what it was the previous quarter, but still pretty healthy and on the way to that $10 trillion target. Some earnings out that aren't related to the banks, that's Delta Airlines. They did actually be on revenue as well as on EPS, and load factors were higher as well for the third quarter. They did give a fourth quarter outlook. Unfortunately, they talk about they're still about 80% at 80% capacity relative to 2019. Of course, a lot of people looking at that metric. The company also saying fuel costs and wage costs are going to be a huge factor here for fourth quarter. It'll be interesting to see what they say on the conference call. Flip up the board here real quickly. Let's hit to Apple. Of course, that was the big news last night. Apple shares still under pressure this morning, down about 0.5%. Again, you're talking about 10 million iPhones shaved off of what was supposed to be a 90 million forecast here. Skyworks, though, and Qorvo, a lot of the suppliers, these are the ones really taking it hard. There was an interesting downgrade on Skyworks earlier today by Baird. Most of that research, of course, came prior to the Apple announcement, and there were some concerns here that there was already a slowdown in some of the component shortages for Skyworks specifically. Of course, the Apple announcement not helping matters. Keep an eye on this space. This will, of course, be all the talk today, that and along with the banks.
Very good. Romain Bostick, thank you so much. Right now, folks, this headline, too important. This from Mr. Putin: Russia ready to supply as much gas as Europe needs. Just in time for the meetings here in Washington, John.
The governor of the Central Bank of Gas in Europe, Tom, let's be clear about it. We heard it last week. We're hearing it again this morning. President Putin out of Russia, Tom, ready to supply Europe. Now, there's two ways of looking at this. Good news, Tom, in the short term. The second way of looking at this is Chancellor Merkel is exiting Germany, Tom, and exiting Germany, leaving Germany and Europe far more dependent on European energy. That's the issue. President Putin still holds the cards. He has the political leverage, Tom, because of this relationship with European gas. And the previous administration was really on Germany's case about it, Tom, in a big way.
Yeah, intraday Brent crude down right on support, 82.70 a barrel. Right now, Seema Shah with us out of the London School of Economics. There's some real distinction there with Principal Global Investors and their chief strategist. Seema, you are decidedly half full. What do the half-empty people, the gloom crew, what do they get wrong?
I think they're really concerned about supply shortages, of course, but I think the market has really priced that in. And now it's about looking for the companies which are, looking away from the companies which are particularly vulnerable. And I think there's a lot of concerns about growth. You know, growth is slowing, but it's still pretty solid. And that should be enough to carry us through. And certainly for risk assets, it's still a supportive environment.
When I look at the supportive environment here, and we saw the supportive environment from JP Morgan, what will you look at for U.S. forward tone that will lead to supportive? What do you want to hear on those endless conference calls?
Yeah, so I think for the banks, it's going to be a little bit different, right? Because they are going to be less vulnerable to some of the supply bottlenecks that we've been worried about. They're less vulnerable to the energy prices. So what we want to see from them is how do they see the consumer panning out? Now, the good thing for the consumer is a little bit of a negative for banks. So that's the thing that we need to watch. But generally from earnings seasons, we want to know what their guidance is on profit margins. So how are they dealing with that? Are they starting to be concerned about wage pressures, or is it something that they can ride through? Or additionally, do they feel like they've got enough pricing power to pass this on to consumers? So those are the nuances that we're going to be watching for. But I have to say, I think we're expecting a pretty solid earnings season. And going into 2021, it's just about maybe a slightly more challenging environment, but still pretty solid.
So the idea that Apple, reportedly by Bloomberg yesterday, it was going to cut production significantly because of the chip shortage, that it has not rippled through markets more, does that indicate to you that we've already priced in all potential supply chain disruptions and that from here you only have upside in terms of those pressures facing certain companies?
I think that there's definitely an element of that. I think the market knows so much about the supply chain issues They know that it's going to last until 2022. They've made that adjustment in terms of expectations. And on top of that, we all hate the word transitory, but maybe some of these problems for Apple are likely to be transitory. This is just the first. So, we should see them picking up some of those gains again once supply shortages are finished.
So, Seema, are you against big tech at this point because you do see the pressure upwards in yields and this idea that you're going to continue to see a further correction there? Or do you think that it's time to go back because they have suffered the most over the past month and a half?
Yeah, we are definitely still supportive for big cap tech, mega cap tech. And the reason is that, yes, it's been a slightly challenging environment with yields, but we do think that that's near the top, right? We don't see that much additional movement from here on, which is going to be particularly steep or disruptive. And then just generally for big cap tech, yes, there are supply chain shortages which will impact them, but the overall longer term demand is still really strong. And as we said, the environment is getting slightly more challenging. This is a time when you want balance sheets, you want the big profit margins, the companies that have the power to deal with some of those maybe margin pressures which are going to be facing the economy in the next year or so.
Seema, thank you. We have to leave it there. Fantastic to catch up with you out of London, as always. Seema Shah there of Principal Global Investors. Let's take a look at Apple in the pre-market once more. I want to get back to that question Lisa asked. I think it's got to be one of the questions of this morning. Apple is negative, but only by 0.5%. We're down to 140.74. We've had this big move lower off the September 7th high, the recent high. We're down about 10% coming into this Wednesday. And Lisa, here's the news. It's hitting Apple as well. We're learning that from Debbie Wu in the reporting out of Taiwan. And we're learning that they're not immune to this. Now, my understanding of this right now, Lisa, what should it be? That Apple has the privilege here that this is profits deferred and not profits lost? Or if this is a broader story for this equity market, that it's some indication we're learning something from the way this market is responding to that story, some indication that maybe we're past the worst of this for this market.
Either that or people are just, high on hopium. I mean, the question is this reality that basically this is all priced in because basically Apple was thought to be able to deal with supply chain disruptions much more than other companies and chip shortages simply because they have incredible pipelines and an incredibly robust business.
Not everybody is bullish. Bank of America saying beyond supply constraints, we're also concerned about the demand headwinds as U.S. stimulus benefits abate, China slowdown impacts sell-through, and people push out upgrades for the next iPhone. So there are some cautious voices out there, but it's interesting. A focus for us this morning, that's for sure. Up 7 on the S&P, advancing a little more than 1/10%, call it 0.2%. Tom Keene out of DC, Lisa Bramett alongside me. I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. Congressional Democrats are still divided over how to slice up President Biden's economic agenda. They are coming together over tax and spending plan totaling about $2 trillion, down from $3.5 trillion in the original plan. But they can't agree on which part of the president's agenda to keep and how long to pay them for. Next month, the U.S. will relax coronavirus restrictions at its land borders with Canada and Mexico. That will allow for the resumption of non-essential travel like tourism. The move comes after the White House said it would start allowing airline passengers from a wide range of countries to enter the U.S. with proof of vaccination and a coronavirus test. Now, Vladimir Putin says Russia is ready to supply as much natural gas as Europe needs. Speaking at an energy forum in Moscow, the Russian leaders said it was very important to stabilize the market. Europe faces a gas crisis ahead of winter due to a surge in prices and a drop in reserves. Netflix says the South Korean show Squid Game has become the biggest series launched ever. The drama has attracted 111 million views since it was released on September the 17th. That surpasses Netflix's previous top show, Bridgerton, which hit 82 million households in its first 28 days of a release. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Might it impact China's growth because it is already slowing? Chinese manufacturers are curbing production. This is the latest shock to global supply chains, already delayed by, part delays, chip shortages, saddled with soaring commodity prices as well.
Well, Haslinda, when we've seen a lot of supply chain disruptions at the beginning of this COVID pandemic, and then, supply chains became resilient and it really moved goods around, especially medical goods and supplies. But now, at this part of the pandemic, we are seeing disruptions again, and discontinuities. And that is because of what we spoke about, the demand that is pent up. And of course, if you have factories slowing down and, not being able to produce as much, that is going to impact growth and the recovery.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
The growth story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Many supply shocks that are manifesting themselves and make for a more persistent and stubborn inflation outlook. Central banks are in a tough position in which they don't want to derail what could be still a fairly uncertain recovery.
That's the theme I want to pick up on right now. That was Carmen Reinhart there, the wonderful Carmen Reinhart of the World Bank, the chief economist there from New York City this morning. Good morning. Tom Keane in D.C. Lisa Bravis alongside me. I'm Jonathan Ferro. Your equity market up 8 points. We advanced 0.2%. But it's the move in the bond market I want to sit on for a moment. Yields in at the long end, a basis point. Up at the front end, a basis point. This is in America. In the UK, a bigger move here at the long end. These curves are getting flatter. Your 30-year yield comes in 7 basis points to the UK to 1.37. 10's at about 1.1%. Yields in about half a basis point, but pretty much anchored on 2s after an elevated move, Tom, off the back of a conversation about higher interest rates in the UK. And this goes back to Carmen Reinhardt's comment there. Are these central banks about to step in because of the price pressure and maybe temper the recovery a little bit? We've seen the move in the UK. We've seen the move in the UK, and we've seen the move in treasuries more recently. Now, it's recent stuff, Tom, but I think it's worth focusing on.
It's worth focusing on, and what's so important here, John, is institutions to the rescue, as we just saw with Mr. Putin talking about gas in Europe. But what's important here to me, John, is the asymmetry between the United States, witness J.P. Morgan, and what we're seeing in Europe over any number of things, including energy. The distinctions to get to this banks between ECB and Fed at the meetings here in Washington has never been wider.
J.P. Morgan in the pre-market, Tom, following those numbers, positive 0.6%, rallying into the numbers and doing okay coming out of them, up 0.6%.
I do want to point out Carmen Reinhart, who you just heard from, is a little bit front and center here in Washington, these meetings, John. She has taken an elevated set of responsibilities at the World Bank because the two-word phrase here is data integrity. The uproar at the World Bank, they need data integrity, and the IMF is trying to reaffirm data integrity. Carmen Reinhart, part of that calculus.
Those reports need some credibility, Tom. Isn't that the issue at play here? They've got to rebuild some of that.
You got to rebuild it, and there's no way better to do that. This time is different. You do it with Carmen Reinhart. This time is always different. That's bank earnings. You bring in Allison Williams, Bloomberg Intelligence Senior Bank Analyst. Allison, I want you to explain what Fortress JP Morgan looks like. These are ratios you and I never studied. We never framed 22% tangible equity. The profitability seems overwhelming. Can it endure?
Well, some of it can. I would say that the two big surprises that we got this quarter are similar to the drivers of positive surprises in recent quarters, and that's the investment bank and the reserve releases. So the reserve releases are something that really helps the bottom line this year, hurt the bottom line last year. And so obviously that's something that's not sustainable. The global investment bank continues to surprise to the upside this quarter. It's really equities, trading revenue growth, very strong. Advisory fees, a new record. So those are key positives. They really set the bar ahead of Goldman and Morgan Stanley tomorrow.
Yeah.
But net interest income, that's the key metric that investors are focusing on this quarter. So for JP Morgan, came in bang in line, which is a bit neutral, but what investors are going to be digging into are what are the prospects for loan growth that can give us a little lift going forward. And so I would say there's enough there to sort of feed the optimism, but you know, nothing over the top. So signs of green shoots is what we're hearing from JP Morgan. We've heard that from Wells Fargo. And so some positives there, but I think needs to get a little bit better.
Allison, broadly, this is being taken as a positive for the economic story as well as for other banks. And yet the advisory fees, I want to really hone in on that, the idea that they hit a record. Could this be taking some of the business, some of the market share away from the likes of Morgan Stanley? Or is the market right to shrug this off and says it's just basically a green light for advisory businesses all across the street?
I think for M&A, it is definitely the latter. I mean, I think it's going to be a great quarter for all the banks. You know, the equity trading side of things, I think, is where you might be seeing a little bit more market shift. But equity advisory fees, and we saw this from Jefferies earlier this month. You know, last quarter was a record for Jefferies. This quarter, a new record. JP Morgan, you know, triple what we were a year ago. That's not that impressive, given it was a weak year ago, but sizable growth from last quarter. And we do think that the fundamentals are there for JP Morgan and for the banks broadly to continue this sort of record-setting M&A pace.
Allison, for people in the audience right now who aren't familiar with the way these earnings are delivered, on the front page, the first page, you get Jamie Dimon's comments down the right side of that page. At the bottom there is this comment here. This quarter, we became the first bank to have branches in all of the lower 48 states. Now, that's not news, Allison, but we know there's been a big push here to expand from the likes of JP Morgan and others. What's the effort here? What's behind it? And how important is it?
It is important, and this is a multi-year plan that's taking place at JP Morgan, similar at Bank of America. They're already significant across the country, but, you know, rounding out their footprint, if you will. And so while there's a lot of focus for banks on technology and the digital side of things, that's really been sort of a boon to the bottom line, and increasingly focusing on the top line. They are building branches in new markets, and you know, the banks are the global banks, the biggest banks, Bank of America and JP Morgan, winning share where they want. And we think this sort of comes back to you know, the level of technology investments that sort of helps them be more efficient broadly, as well as, you know.
Okay, guys, traders, well done. We closed trade. So all of you guys who got the strategy, followed my trade, and practiced it, you made a profit. Okay, you close your trade, use the strategy, see where you closed it, so you will know how it works. Okay, and let's move on. Let's see, just midday. So let's see what other trades, what other trading opportunity will bring us. Okay, if you have a strategy, try to use on other securities or indices as well. Okay, guys, I'll speak to you later. Stay safe, guys.
Keen, Lisa Bramett and Jonathan Ferro on radio, on TV. This is Bloomberg.
I'm Jamie Maggio with an exclusive BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. American women hit the headlines Tuesday at Indian Wells. Shelby Rogers came through a 3-set thriller against U.S. Open finalist Leylah Fernandez on Stadium 1. After being outplayed in the opener, the American leveled it at 1-all before clinching the victory in the deciding breaker to reach the quarterfinals for the first time in her career. Earlier, Jessica Pegula enjoyed one of her biggest wins of the season as she dispatched the #4 seed Alina Svitolina in straight sets. And Alexander Zverev took care of business against Andy Murray in the battle of the heavy hitters on the men's side. The German claiming his first win over the Scot in 2 tied sets on his way to the round of 16. And don't forget, Tennis Channel's exclusive daily live coverage hits the air at 1 p.m. Eastern.
When I had a look, it looked like she was blind. The vet that she's registered with were only doing telephone appointments, which was a bit pointless because she really needed to be seen by someone. And I couldn't get one anyway for like another week. I was just quite worried about, you know, the complications of leaving it for so long.
We've seen millions more animals becoming pets in the past year due to the people having increased time at home. What we're also finding is due to Brexit that we're having decreased numbers of European vets working over here. So unfortunately, we're unable to meet that current demand for pet services. Also, COVID's got the inevitable impact with people having to self-isolate.
It is very limited what we can diagnose, so it's more about peace of mind and determining whether they do need to be seen in person.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
from New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Inflation that normally shows up later in a recovery is we're getting a blast of it early.
It's a difficult market to navigate right at the moment because you do have this sort of stagflation narrative.
This right now, we're seeing narratives that are completely new to us.
Markets could be a little bit more fragile to any disappointing news flow.
If your sort of question is simply, is growth going to slow next year? The answer to that is a resounding yes.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene from Washington, in the meetings of the IMF and World Bank from New York, and the meetings of J.P. Morgan on conference calls worldwide with an inflation report in this hour. John, a busy day.
A busy day, Tom, and so far so good. J.P. Morgan doing okay. Next year, the IMF predicting what? 5% GDP growth in America. It's not about sufficient demand, Tom. We've got that. It's about insufficient supply, deficient supply, meeting that demand, and higher prices that are mixed because of those two things mixed together, Tom. Do those higher prices hit growth? We get prices in 29 minutes' time.
And we forget the scale here for the moment. J.P. Morgan minting on the operating income line, 150 million plus per day, John. These are giant companies. Apple in the news, J.P. Morgan in the news, and they survive this pandemic.
Investment banking fees, Tom, up by 52%. IPO activity good, M&A activity good. Companies aren't just sitting on their hands. They're getting to work, and the banks are clearly picking up some fees.
A little bit of transitory inflation worry. Maybe we'll hear about that. Bank conference call, maybe not. But Lisa Abramowitz, we will hear about inflation. Lisa, every single person I ran into in the airport, on the airplane, started with inflation.
This is what people feel in their real-time, day-to-day experience, whether it's going to the store and how much they pay for a gallon of milk versus building a home versus paying for gas. The question that I have is, are the biggest companies going to be the best qualified to be resilient through this period? And this is something we've been talking about throughout the morning. And frankly, John pointed this out. J.P. Morgan is expanding significantly. The big are getting bigger. How much is this going to be a feature of the economy going forward? It doesn't necessarily predict what's happening in some of the smaller companies.
It's a huge story. I really strongly take the point of the monopsonistic tendencies here and the idea of how does small business deal with this. And John, they do it within interest rate dynamics. Both you and I are looking at a yield regime today, very different from 3, 4, 5 days ago.
Tom, this curve is flatter. At the front end, yield to higher. At the back end, yield to lower. You can see that again this morning on 10s in America. Your 10-year right now down a basis point to 156.47. You can see it in the gilt market as well, Tom, in the UK. Flatter curves. And this front end story, it's not just a story for the belly of the curve anymore, about when the Fed might hike, how quickly they'll hike a few years down the line. We're talking about the very front end now, twos. A conversation about the back end of next year. That's been pulled forward, Tom, in a way that 6 months ago just wasn't really in the mix.
Right. John, let's take a pause on Washington here and part of the recovery from this pandemic, and it is very different in other geographies. We spent a lot of time on Australia yesterday. Good morning, Brisbane. But John, at these meetings of the International Monetary Fund, not said, but there is the missed call of last year. John, did you know the dollar was going to be weaker?
Oh, yeah. And then what did we get? A stronger dollar.
Yeah, exactly.
Tom, through Q1, and now we're seeing it again. And why are we seeing it? Because the Fed, there's clearly a sensitivity to inflation. We thought they'd really tolerate higher inflation. And now you start to hear the likes of Raphael Bostic, Tom, of the Atlanta Fed, calling transitory a dirty word, just not believing in it. And I just wonder whether he gets some company, a little bit more company, in the months to come. We'll get the data at 8:30 Eastern. It's 27 minutes away.
Let's do the data right now. We mentioned yields are in a little bit. John, green on the screen, and the VIX nicely in under 20.
Your equity market, a lift up 10, advancing 0.2%. In the FX market, euro dollar, euro stronger, 115.61, advancing there a third of 1%.
Look at West Texas.
Just about hold on to 80, Tom. $80.01 on WTI. We're down by 0.8% on the day.
We're going to sum it together. Patrick Armstrong has become one of our most nuanced and interesting voices with Plurimi Wealth. 3, 2, 1. Plurimi Wealth. I had too many Plurimis last night. Plurimi Wealth, their chief investment officer. Patrick Armstrong, we're setting up here to get to the end of the year in frame 2022. In investment, how do you structure for next year?
Well, what I think the yield curve is getting wrong right now, and it's brave to say the yield curve is wrong because the bond market's smarter than the equity market, but I don't agree with the flattening right now. I think the Fed, some of them are changing their tune on whether inflation will be transitory, but I do think hikes, it's going to be a very high bar before we see hikes. I think ending QE 100% makes sense. I think that'll lead to a steepening of the curve as we get to the point where there's going to be strong growth next year. Unemployment's already below 5%, so the Fed, with its dual mandate, is going to have rising inflation, I expect. It's going to have a reasonably low level of unemployment. But that bar for hiking rates, I think they've learned their lessons from 2018, and they're really not going to want to hike early. So I do think they will let the economy run hot. We've got inflation now. It's probably the wrong kind of inflation, where it's not really just led by demand. It's the logistical issues and the bottlenecks that are creating some inflation. And monetary policy is impotent against that kind of inflation anyway.
So, Patrick, if I'm thinking about supply-side risk fading through next year, if I'm thinking about this conversation of higher interest rates going back into the back seat, do I want to pivot away from, say, the banks and back to industrials? Industrials have lagged so far because of the supply-side issues. Financials have rallied because people think out there we're going to get higher rates. Would you fade one and go back into the other?
I actually think financials are going to be set for a very good 2022 because we're not going to get the higher rates, but I think we are going to have the steepening of the yield curve, and that leads to a very strong interest rate margin for the banks. I think inflationary pressures are going to remain. I think they will transition from supply-driven to just a relatively strong economy where demand is continuing to grow. And I think that's a healthier kind of inflation. If we do get wage growth, which I expect as well, given the difficulty small companies are having at filling vacancies, I think you have to have higher wages. That leads to higher consumption as well as higher cost structures. So I don't think banks are going to suffer because that steepening of the yield curve will be beneficial for them.
Patrick, just listening to what you're saying, it seems like you do think that supply chain constraints are going to work themselves out sooner rather than later, and this seems to be the big distinguishing feature in markets of the bulls and the bears. We saw from the reaction, or the lack of a reaction, frankly, to the Apple news yesterday, that perhaps some of the supply chain disruptions are fully priced. Do you agree with that? Have we fully priced the chip shortages and all of the delays that we're seeing in shipments?
The chip shortages, they have to be fully priced. We've been talking about it for months now. No one can be surprised that Apple's not able to get the chips it needs. There probably will be, I think, issues on maybe some more of the consumer stocks on manufacturing, COVID-related things like we saw with Nike and Vietnam, things like that. Maybe they haven't been headlined as clearly as the chip issues, but it shouldn't shock anyone that there have been supply disruptions. And then the question is, does that change demand, or is it just deferring that demand for 1 or 3 quarters down the line? So fully priced in is maybe hard to say, but definitely a big chunk of it should be priced in by now.
Patrick Armstrong, Daniel Alpert, the gentleman of the age of oversupply, has just released a definitive white paper where he compares the inflation of the 70s to the inflation now. He says this inflation is unique. It is biological, off of the pandemic as well. If we get subdued inflation, how does that affect the stock market?
If we get subdued inflation, then we've got very accommodative monetary policy for a very long time. I actually am in the camp that inflation is going to be stickier than people expect, and this transitory concept. I think we're in an environment now where the path of least resistance is higher prices. We've had a 30-year disinflationary backdrop based on globalization. I think that's run its course now. Clean energy, making things at home, that's a higher cost structure. And we've had lack of investment in fossil fuels in many aspects of production. You've just seen low levels of investment, and you've got a burgeoning demand. So I actually think prices will continue to move higher. And it's the disinflationary backdrop probably is over. The pendulum's swinging the other way now.
Interesting. Patrick, we've got to leave it there. It's always good to catch up, sir. Patrick Armstrong, the Plurimi Wealth CIO. Your equity market up 0.2% on the S&P. On prices, some data on CPI in America. CPI data 20 minutes away. This came from the Federal Reserve Bank of New York survey of inflation expectations yesterday on the consumer. Lisa, I see you nodding because I know you saw this one too. Expectations 5.3% from 5.2%. The reading for 1 year and 3 year consumer price expectations, the highest in the survey's 8-year history. Question is, do they matter? Do they matter to policymakers?
And this is actually a heated debate on the Federal Reserve, as we saw from that white paper a couple of weeks ago. The idea here being that perhaps they are predictive because people expect prices to rise. They're willing to spend more on goods now versus not necessarily being indicative. Nonetheless, that's exactly what I was thinking about as we were listening to the previous conversation. Well, I mean, it just, to me, this is the key question. Is this persistent, and can it be good persistent rather than just something that takes growth away?
So consumer price expectations higher. Put this together with some JOLTS data that we got yesterday, Tom. Job openings fell back just a little bit, but take a look at the quits rate. The quits rate rose to a record, just short of 3%. That's a real pickup that you've got to take notice of, Tom. People willing to quit their jobs. Why? Because there's some confidence out there. You only quit your job, Tom, if you feel confident that you can get by and perhaps get another one.
It's a confidence of 4% GDP. John, as I mentioned earlier, and I understand there's 47 decisions on glide path, but the real glide path here is we're not at the boom economy of 12 months ago, but it's still a pandemic-affected, good economy. Where will it be in a year?
Yep.
Who knows?
Or Lisa, you're unhappy about who you're working with. You know, that's
she had a good auction yesterday.
There's plenty of other reasons. I'm suggesting there are plenty of other reasons. Up 9 or 10 points in the S&P. Up 0.2%. From New York this morning, good morning. On radio, on TV, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The deal makers at JP Morgan Chase posted their best quarter yet. Fees from advising on deals almost tripled in the third quarter. That crushed analyst estimates and helped to push JP Morgan's net income to $11.7 billion. CEO Jamie Dimon says the bank has weathered the Delta variant and supply chain disruptions well. On Capitol Hill, the House has approved a short-term increase in the government's debt limit. Lawmakers are sending the legislation to President Biden just days before the Treasury was at risk of running out of borrowing authority. Still, what that means is there's likely to be another partisan confrontation over spending and debt in less than 2 months. Now, OPEC is sounding a cautious note on the strength of oil demand. That is despite international crude prices surging above $80 a barrel for the first time in several years. OPEC has revised down its estimate for global oil consumption this year. The cartel also said that the spike in natural gas prices could boost petroleum use in some areas, but hurt it in others, such as refining. The European Union will offer a new round of concessions to the UK over Northern Ireland in the latest Brexit negotiations. The EU will propose cutting as much as 50% of the customs checks in Northern Ireland and up to 80% of the sanitary checks on food imports. The Northern Ireland Protocol keeps the province in the EU single market, unlike the rest of the UK. The UK wants changes to that agreement. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You
drop
look great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Is inflation really transitory, or is there a risk that because we believe it's not transitory, it actually becomes sticky?
I think central banks are really worried about inflation now. Much of what we see probably is transitory, but nevertheless, it's a lot easier to see upside risks to inflation than downside risks. None of us know where inflation will go over the next year or so, but upside risks are coming, I think, from three sources. One, as we gradually learn to live with COVID-19, the bottleneck effects are pushing up some prices. Secondly, energy prices, we've seen, even yesterday, they moved all over the place for gas prices. We don't know where they'll go, but it's much easier to see upside risks than downside risks. And third, and I think one which is very different from the past 20, 30 years, is that the political risks are also much stronger. There's real pressure now to boost public spending, but not to raise taxes to finance it.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh, my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
Google is saying it has accelerated innovation in the country, and it's planning to appeal the FTC's decision. What's your take on this, and how do you plan for further scrutinies?
We are going to see what they make and what changes they are actually bring to this market.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
The substantial further progress standard has more than been met with regards to our price stability mandate, and as of the September meeting had all but been met with regards to our employment mandate. The committee indicated that if progress continues as expected, we judge that a moderation in the pace of our purchases might soon be warranted.
The light is still green for the Federal Reserve on November 3rd to taper bond buying. That was Vice Chair Richard Clouder there from New York City this morning. Good morning, Tom Keene, Lisa Bramett and Jonathan Ferro. We are 12 minutes away from CPI in America. Equity futures are positive 0.2%. Yields are lower by a basis point at 156.12. Crude softer, negative lower down 0.7% to $80 and about 10 cents. We've heard from Jamie Dimon, the CEO of JP Morgan, a couple of times this week. We hear from him again this morning following earnings on the supply side story, Tom. This from Jamie Dimon. A good chance in a year we won't be talking about supply chains anymore, that maybe Tom will have moved on.
I would say that has some merit because of the worldwide context he must have in understanding what's going on in Shanghai or Singapore or others. So, John, I don't take that lightly. What
I don't
Dimon
either,
says
Tom,
about
but
this.
when you speak to specific industries, specific companies, they talk about these difficulties going on a long time, maybe through 22.
Yeah. Well, certainly through the holiday season, we've already gone into full-scale shopping in the Keene household. This is an important conversation. One of the great moments of Bloomberg surveillance, John Farrow was there as well with Francine Lacroix, was Kenneth Rogoff and Joseph Stiglitz on set with us in Davos. It was a trenchant moment in World Bank IMF history. We are honored today to have the laureate Stiglitz with us from Columbia University to sketch out the uproar in Washington over data integrity. Joe, I thought you covered so much ground in your Project Syndicate essay in your defense of the managing director of the IMF. The question seems to be, if we're going to do data, try to choose data that's not politically tinged. Have these meetings and these institutions that you worked at, have they become too political?
Well, there's always going to be a political element. The report that was the subject of all this controversy was the Doing Business report. And that was a report that was always problematic. In fact, just a decade ago, I testified to Congress about why that was a bad report and ought to be scrapped. They said that doing business meant, doing well on that meant not treating your workers well, weakening labor market protections, lowering corporate income tax. My view was progressive taxation finances infrastructure, and that makes, and education, that makes for a stronger economy. So you're absolutely right. If you're going to have data, make sure that by its very nature, it's not a political database.
Joe Stiglitz, do you believe that Dr. Georgieva, or whoever follows on from David Malpass at the World Bank, will they be tinged by this? Does she have too much baggage now to do her job for the remaining 3 years?
Absolutely not. In fact, if you look closely at what she did, she stood up for data integrity. What she said is, we're not going to monkey with the methodology. She instructed her staff to make sure the data is right, do exactly what I would have done if I were in a position. And it turned out that when they looked at the data, there were some rounding errors. They adjusted things. And the difference, this whole controversy is about whether China was at 83rd or 75th in the ranking. And that difference is not statistically significant. It's basically a tie. And what they said was, our data confirmed what we said before, with a little adjustment. What they should have done is explained the lack of statistical significance to this difference between 75 and 83rd.
Professor Stiglitz, there's a broader story here of increasing politicization of central bankers in general, of some of the financial authorities around the world. And I speak about this with the Federal Reserve, in particular, Randy Quarles stepping down as the vice chair of supervision. How much does this weaken the role of the likes of the Federal Reserve going forward at a time when they are more pivotal than ever to markets?
You cannot remove our regulatory authorities from the political context. You know, we had a crisis in 2008. Some people seem to have forgotten that. And one side of our political spectrum says it didn't occur, and we ought to deregulate. The other side says 2008 actually occurred. It occurred because we did not have adequate regulation, and we need to maintain a strong regulatory framework. That has become political. But it's also the essence of economics. And the same thing goes for climate change. Climate risk is a financial risk. Countries all over the world have recognized it. But in the United States, we seem not to have fully taken this on board. And I'm very concerned that the chairman of the Federal Reserve has not taken on board the real risks associated with climate change to our financial system, to our banking system.
Professor, what do you say to the accusation that your own thoughts might be shaped by your own politics? I'm reading the Project Syndicate piece. You defend the managing director of the IMF, but you raise the issues with the World Bank president, David Malpass, which of course was supported by the former administration. You're now going after the chairman of the Federal Reserve, which of course was nominated by Republicans. What would you say back to people that said your own views are shaped by your own personal politics?
Well, I mean, obviously, the issues we were talking about, regulation, climate change, are issues I feel very deeply about, but there are also economic issues. In the case of David Malpass, Bloomberg itself exposed the attempt of David Malpass to interfere with the methodology that was used in the Doing Business report, a far graver concern than telling your staff to make sure the numbers are right. And yet it is so strange that there has been no discussion about that intervention in the methodology, a far graver concern than what she did, which was trying to maintain the integrity of the data, given the methodology.
Professor, we appreciate your time. We always do. Thank you for your contribution this morning. Joe Stiglitz there, the Columbia University professor, and of course the Nobel laureate in economics. From New York City this morning, good morning. Tom Keene over in Washington, D.C. for the IMF World Bank meetings here in New York City alongside me. Lisa Bramett, I'm Jonathan Ferro. We are 5 minutes away from CPI data in America. Your equity market is up 0.2% on the S&P, advancing around about 7 points. Into the bond market, the shape of things as follows. On Treasury yields, lower by a basis point on 10s to about 156.64. In the FX market, euro dollar 115.59. In the commodity market, we're negative 0.6% to $80 and about 12 cents. We've got more work to do. Mike McKee is in the seat. I can see him. That means he's ready to break down CPI data in just a moment. Then after that, Neil Dutta of Renaissance Macro, the research head of U.S. Economic Research. All of that still to come. It starts next. This is Bloomberg.
As Magnus TV in Facebook since I'm streaming Axie Infinity. Axie Infinity is an NFT game where you can earn tokens, and then that tokens can be converted into pesos. I'm playing almost 4 to 5 hours a day. I'm earning, I can say it's really a lot of money. It can help to sustain my family needs and also to sustain my own business that I'm starting. I'm a little bit worried about it because some people who join this Axie Infinity thinking that this is an easy money game. They can earn a lot on this game. This game can sustain their life. And I think that is not the point, or that is not really the game. We are trying now to build a community where other players or my scholars can join this esport, playing Axie Infinity for even 5 years, I think.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
CPI in America seconds away from New York City this morning. Good morning. On radio, on TV, alongside Tom Keene and Lisa Bramett, I'm Jonathan Ferro. Your equity market shaping up as follows. Up 8 points. We advanced 0.2%. With your data, it's an upside surprise. Here's Mike McKee.
These are not the inflation numbers Jerome Powell was looking for, John. CPI comes in up 0.3%, up more than 0.3%, because at this point it's a 0.4 gain. I read that wrong, and 0.3 in August. Over the last 12 months, the all items index is up 5.4%. That's before seasonal adjustment. Food and shelter rose, contributing more than half of the monthly all items increase. The index for food up 0.9, the index for food at home up 1.2% on the month. As for the CPI core, we're coming in at 0.2 gain, which is what was anticipated. Pushes the core rate, doesn't change the core rate, stays at 4%. So we are getting more inflation. It is not going away, but it is showing up in the headline numbers more than the core numbers at this point.
Mike, pour through it for us. I just want to go through the market action just quickly. Up 11, call it 10, call it 9 on the S&P. We're positive 0.2%. Pretty choppy out there at the moment. The curve responding as follows. 30s are still firm. Yields are lower there by 2 basis points. There's a lift at the front end, 2s out to 3s and 5s through the belly. We're up about 2 basis points on 2s now to, let's round it up, 35 basis points or so. 3 years, 65 basis points, up by 3 basis points. The 5-year up by a couple of basis points here. Euro dollar, where are we now on euro dollar? 115.56. Euro still a little bit stronger. Euro dollar 115.56, up there by 0.2%. Mike McKee, your thoughts on what this changes, what it won't change for the Federal Reserve conversation on November 3rd?
Doesn't change a whole lot because, as I titled that CPI chart, the inflation numbers have more than met the Fed's target, according to Vice Chairman Rich Clarida yesterday. So the Fed is going to be on track probably for its taper. It doesn't mean really anything at this point in terms of a tightening. The Fed is at pains to make sure the market understands that just because they start tapering, they're not ready to start tightening. The numbers today might create a kind of an argument, and you and Neil Dutta can get into that in just a moment, about whether the headline number is something the Fed should react to or the core number, because the core number stays where it is and could start coming back down. Just want to mention quickly, gasoline was up 1.2%, but in August it was up 2.8%. So the oil price rise hasn't yet filtered into that headline number, and that'll come next month probably.
$3.27 a gallon on AAA unleaded as well. Michael McKee, thank you so much. And this ratio idea, this compare and contrast, folks, of price change, whether it's top line or core or the 47 other flavors of inflation, it's an art unto itself. On this and on the American economy, we're welcome Neil Dutta, Renaissance Macro Research Head of U.S. Economic Research. Neil, I want to cut to the chase. We're addicted to 7, 8, 9, 10% economic growth. OMG, economic growth is coming down, but what permeates your note is, you know what, demand's pretty good. Are we still in a boom economy?
Absolutely. I mean, I think there's a lot of talk about stagflation, but really what's going on is we have an inflationary boom. I mean, stagflation is when demand is slowing down and prices are remaining firm. Right now, one of the reasons why prices are still firm is because demand is still quite buoyant. So that's true whether you look at ISM, right? So as an example, new orders are still quite strong, even though prices paid is still elevated. But that's also true in the economic data, the hard economic data, right? Aggregate hours worked are up something like 5% over the third quarter. So that's basically a rough proxy for real GDP, looking at the job market, and that's alongside strong growth in prices. So that doesn't smell like stagflation to me. It looks more like an inflationary boom.
At New York University, they weaned you on microeconomics and the many ambiguities of the dynamics for small business, for mid-sized business, even for Apple Computer and JP Morgan today we saw as well. If things are good and you need to bid for labor, what's the ambiguity of paying a higher wage? That's just the cost of doing business, right?
Well, sure. I mean, and then we are seeing that. You know, well, I think the bigger story, Tom, really is that the labor markets look a lot tighter than you would think, given the fact that we're still 5 million or so jobs in the hole relative to where we were before the pandemic. You know, so we need to. I mean, I do think it's a risk that labor supply isn't sort of reviving in the way that you know, many of us were expecting earlier this year. You know, if that remains to be the case, I don't think it's the base case quite yet, but if that remains the case, the Fed has a problem on its hands next year.
Well, Neil, I want to go exactly there because the first thing that I did when I saw a 5.4% annualized CPI, consumer price rise, I looked at the real wages. And basically, they are negative. Yes, wages rose by 4.6% about in the month of September. That's not keeping pace with the price of gas, with the price of housing, with the price of so many other basic staples. At what point does this become concerning and really present, as you said, the real issue for the Fed?
Well, it's not concerning yet, Lisa, because remember, it's not about average hourly earnings yet. At least it's not yet. What matters is the sum product of jobs, hours, and hourly earnings. So it's not just about what people are making each hour. It's about how many people are working and how long they're working. When you look at that, that's basically what we call formally the index of aggregate weekly payrolls. That number is growing very robustly, even though we're still millions of jobs in the holes, which presumably means that there's even more upside for it. So if you look at that number, it rose about 1.4% over the month in nominal terms, right? So you know, ex inflation, it's still up very healthy in real terms. And that's ultimately what drives consumer spending. So it's not just about how much everyone is making on each hour that they're working, but how many people are working and how long they're working. That's ultimately what tells you that's what informs sort of the aggregate wages and salaries that the labor market is producing for the economy. And when you look at it that way, it's still underpinning very, very strong consumer spending growth.
Neil, to fold in the moment of this Wednesday and the combined different stories that we're facing here, there's a colossal mystery and true gloom worry about how we unwind ourselves from this fiscal excess. To a great optimist like you, how can we be confident we get beyond the trillions of dollars of debt we have had to incur in this pandemic?
Well, I mean, I think ultimately, you know, there's two ways you can deal with it, right? I mean, it's either inflation or growth, and it looks like we're having a little bit of both. So I do think, you know, stronger economic growth will help alleviate sort of these debt service issues. So that's sort of how I think about it, Tom. But I think the main policy risk is, frankly, demand isn't a problem. We have policies that are being set as if demand is a problem. That, to me, is the principal concern for the U.S. economic outlook. And what it basically means is that if we overdid it, we're going to have to abruptly shift course at some point. And, you know, I think for financial market participants, that basically means that the Fed may start a little bit later. I mean, that's what their guidance seems to suggest. But once they start, they're going to go more aggressively than the forwards imply. So if the post-financial crisis period was about them going sooner to go more slowly once they started, I think the post-pandemic experience may well be that they start later, given their, you know, new framework.
Well,
go ahead. Sorry, Lisa.
No worries, Neil. I'm looking at the 2-year yield right now, and it is going higher. It's probably the biggest mover on the heels of the CPI report, basically bringing forward the potential for a rate hike. Do you think that markets are wrong here? Do you think that basically this is following the old playbook for the Fed and not the new one?
Well, I mean, I do think that, I think the Fed's, what we call their reaction function, is very much in flux. I mean, there may well be some people that are at the Fed right now that want to get going with rate hikes sometime in the middle of next year. But are they going to be here next year? We know that the Biden administration isn't going to be able to pull the fiscal lever next year, which makes it in their political interest to pack the Fed with people that have more dovish proclivities. And so they may well look at the economic data in a different light and kind of hold the line on the front end of the yield curve, more so than some of the people that are there right now, right? So if more dovish members rotate in, I think that you could see a still dovish Fed in 2022. If that continues to exacerbate some of the inflation issues that we're talking about, eventually they may have to back off. But I don't see it as a risk for 2022, but I do think it's a risk going forward.
Hey, Neil, just quickly, when do you expect to hear from the administration on some picks? We've got a lot of open seats coming up.
Right. Well, I mean, they got their hands full right now with, trying to pull the trigger on this, on the Build Back Better program. And, I think the Biden administration needs to corral some of these progressives to get that over the finish line before they, essentially piss them off by nominating Powell again, because I think that's ultimately what's going to happen. So he needs to sort of use them for this before he abuses them on the Fed.
Hey, Neil, great to catch up. As always, sir, thank you. Neil Dutta there of Renaissance Macro, following that inflation data in America. Coming up in about 20 minutes' time at the top of the hour, we'll catch up with Erin Brown of PIMCO on this equity market, alongside Julian Emmanuel of BTIG, and with Tony Dwyer of Canaccord on this earnings season as earnings get underway, Tom.
That's a hell of a good lineup, folks. Stay in touch with that for where we're going, not only this week, but into the end of October. John, I would point out that Mr. Dwyer has a cardinal rule: if you don't see a recession, it's a bull market.
And the discussion of rate hikes, Tom, money markets see the Bank of England rate at 1% in December next year. So that's not one hike, that's a few. It's an interesting conversation starting to build in the money market in the UK. Futures now unchanged on the S&P. Yields are higher by a couple of basis points at the long end on 10s. That's a turnaround, 159.62. With Tom Keene down in Washington for the IMF World Bank meetings. Lisa and I holding the fort down here in New York City with earnings season really underway now, with the big bags pouring through tomorrow. Looking forward to covering that with you on radio, on TV. This is Bloomberg.
Democrats are still divided over how to slice up President Biden's economic agenda. They're coming together over a tax and spending plan totaling about $2 trillion, down from $3.5 trillion in the original plan. But they cannot agree on which parts of the president's agenda to keep and how long to pay for them. Next month, the U.S. will relax coronavirus restrictions at its land borders with Canada and Mexico. That will allow for the resumption of non-essential travel like tourism. The move comes after the White House said it would start allowing airline passengers from a wide range of countries to enter the U.S. with proof of vaccination and a coronavirus test. Now, Vladimir Putin says Russia is ready to supply as much natural gas as Europe needs. Speaking at an energy forum in Moscow, the Russian leader said it was very important to stabilize the market. Europe faces a gas crisis ahead of winter due to a surge in prices and a drop in reserves. The man who played Star Trek's Captain Kirk back in the 60s is set to become the oldest man to go into space. Jeff Bezos' rocket company will launch 90-year-old actor William Shatner and 3 others to the edge of space today. It will be Blue Origin's second mission with tourists on board. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Guerin. This is Bloomberg.
you think at the low point of the Greek economic debacle? What were you thinking about to make Greece recover as it has?
Well, Tom, we took over in July 2019 with a very clear mandate to make the economy grow again. We were hit by the pandemic, but we still managed to implement very significant reforms, and I think we used the fiscal room that was available to us to support the real economy. We're very encouraged by the recent data. The economy grew 16.2% in the second quarter of this year. We revised our forecasts upward to 5.9%, and this may be a pessimistic forecast for 2021. We see lots of interest for foreign direct investment by American companies, European companies. We're making big progress in digitizing the state. We have a very ambitious green transition plan. And overall, I think the mood in the country after 10 years of crisis has significantly changed.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The current prices, oil, gas, coal prices are a serious challenge for the global economic recovery through higher inflation. And as such, those prices I would like to see as lower than they are now.
Fadi Birol of the IEA there with comments on the present energy market. Lisa Abramowitz and Tom Keene on radio, on television. We welcome all of you here to an exceptionally important conversation. Birol's IEA today put out a blistering 4-page executive summary which flat out says the distance from Madrid to Glasgow is profound. This is the gathering of the elites worldwide at COP25 and on to Glasgow and Scotland and COP26 here in a matter of days. Ellen Wald is expert in all of this energy talk with the Atlantic Council and joins us this morning. I'm sorry, Ellen, within the pandemic in 2019, Madrid is ancient news. Fadi Birol talks about the stubborn incumbency of fossil fuels. They won't go away, will they?
They won't go away because if we still want to have electricity and we want to have transportation, we really don't have other options at this point. The technology just isn't there for us to rely on renewables to supply the kind of energy needs that our modern life requires.
How much, Ellen, can the big oil giants, can the big energy players really play a leading role, considering that the transition fundamentally threatens their business model?
The transition fundamentally threatens their business model, except that the transition still relies on fossil fuels. In fact, one of the most interesting things that came out of this report, which I think in some respects is not so useful, but in other respects can be useful, is that we're just under-investing in energy all over the place. There's not enough investment in fossil fuels. There's not enough investment in renewables. There's not enough investment in other forms of energy like nuclear and other things in order to meet our growing demand. So energy companies, big legacy energy companies, definitely play a role. They play a major role in research. They have incredible resources to be able to research new ways to and breakthroughs in energy. And it's just as likely that we could see a breakthrough in clean energy technology from a company like Exxon than we could from a startup from Silicon Valley.
The question is,
I wouldn't count those out, but
no, the question is, where should this money, I don't mean to interrupt, but where the money comes from, right? Should it come from the public sector or should it come from the private sector? And I do wonder, as we see the price of oil climb to the degree that it has, does this actually expedite the transition to greener technologies and, frankly, the investment there from a market perspective, as long as that oil price is allowed to rise?
Absolutely. That's a really, really good question. I think the answer is, if you really do want to have an effective energy transition, you need to have money coming from both the private sector and the public sector. The public sector can be really, really helpful in things like infrastructure development, planning, those kinds of things, some types of incentives. But at the same time, we do need to see money from the private sector. And yes, higher oil prices can lead to more investment. This is a cycle that we see over and over. We saw it in the 80s when oil prices became very high in the 70s, but a lot of that money oil companies put into developing more resources. And we know today that especially the big energy companies will put resources into natural gas and other types of renewables or clean energy technologies. So it's not like that money is just going into building more oil fields and mining more coal. The question really is, when are we going to see more of that? Because right now, we're not seeing that investment being put in. We're seeing money mostly being returned to shareholders.
Alan Wald, I'm going to lean on Mark Maslin here, one of the giants of climate change analysis. And folks, this is wicked nerdy, wicked science discussion. And the bottom line is we drift from Davos to Davos, COP to COP, and we're trying to get something done. And what Maslin and many others say, at the margin, it's about the big players. Who's the big player that has to get their act together?
China, without a doubt. At this point, China is manufacturing a lot of the world's steel and a lot of other really important products, and it's doing it in the absolute dirtiest way. And if you want to look at global emissions, if you're looking at climate change and emissions on a global scale, then China is the big emitter. Yes, Western countries definitely emit more per capita, but with the way that we rely on China for so many of the key goods that we consume, we have to address China's methods of production.
Ellen, how optimistic are you that we're not going to lose this fight?
Well, I'm generally pretty optimistic, and I think that we're not going to lose the fight. We're not going to, see catastrophe happen, in the next 10 or 20 years or in the future. I do think that humanity is very resilient, and also that we will develop new technologies. These new technologies will come. The problem is that they're not here yet. But I do believe in the ingenuity of the human race and the human mind, that we will develop better clean energy technologies that can support our growing energy needs.
So what's the goal out of Glasgow? What's the goal to make Dr. Wald happy with the COP26 meetings? What needs to get done?
What I would really like to see is an acceptance and an acknowledgement of the reality of the energy situation. And I think that that's become that's really risen to the forefront now that we're seeing much higher energy prices in Europe and Asia, the potential for even to experience brownouts and blackouts, or to have to really cut back on consumption over the winter. So I'd like to see a recognition that this is the reality of the situation that we're in, and we need to make a decision. Do we want to cut back on our power consumption? Do we want to say, look, we may not be able to supply continuous electricity to everyone in the developing world, if we, or in the developed world, if we want to, pursue these ambitious, clean and renewable energy goals. But at the same time, I'd also like to see an acknowledgement of what's going on in the developing world and the energy poverty there, and the need to really bring energy and electricity to these people.
Yeah. Ellen, nobody cares. All we want to know is when we get a new edition of Saudi Ink out. When are you going to put out a new book?
We'll see about that. It's definitely coming.
It's definitely coming and is a moving target. Ellen Wald, truly definitive on Saudi Arabia and the royal family at the Atlantic Council, and their senior fellow as well. Lisa, I was at Paris, and all I can say is Paris had a lot more common sense than cop this and cop that, where it was about tangible solutions by smaller players rather than what do we do about China?
Yeah, and these big questions, these big ideas, and frankly, a lot of senior officials saying we're not winning yet, and we are concerned.
We got much more coming up. We've got some flat markets here, futures off a little bit as well. That inflation statistic, important. Tomorrow, we look again at the banks. Francisco Blanche on oil in the 12 noon hour. This is Bloomberg from New York, from Washington.
Madison Square Garden eyelet jumpsuit, which is arguably, from what we're finding out, probably one of the most important jumpsuits of Elvis's entire career. So it marked so many milestones, really, for him. It was used for an album cover. It was used when he performed Madison Square Garden, and he was the first performer to ever sell out 4 nights straight in Madison Square Garden. So he really started that whole thing that we see now in pop culture, where when you make it big, you do Madison Square Garden. So we're super honored to have it. I can honestly say that COVID has been unbelievable for internet-based and e-commerce businesses, because we have a captive audience. We have people home that really want something to do and need entertainment. So we do our best to try to give it to them.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. We've got a lot to work through this morning. From New York City, good morning, good morning. Your equity market on the S&P, just a little bit softer, negative 2 points. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York, we begin with the big issue. Earnings season is underway.
Earnings season.
There are a lot of question marks.
Let's start with what's happening.
Obviously, supply chain disruption is the highlight of
the question will be,
are companies going to be forced to eat these increases in cost?
This is foregone profit.
Or are they going to be able to pass it along in the form of higher prices?
Which companies actually have pricing power?
It's going to be less about results for the trailing quarter and more about the future outlook.
We're going to hear a lot about the macro picture.
We're going to get a mixture of responses.
Really, people are going to be looking for is guidance.
Earnings season is really about guidance.
This is going to be a fascinating earnings season.
Let's get straight to it with Canaccord's Tony Dwyer, PIMCO's Aaron Brown, and BTIG's Julian Emanuel. Let's start with you, Aaron. What are you looking for this earnings season with JP Morgan behind us and a whole host of companies in front of us?
I think it's really going to come down to two things. One is going to be earnings guidance, as we heard in the earlier clip. And then secondly, what's going on with margins, particularly as we start to see costs continue to increase. There was an expectation largely that we'd start to see labor costs coming down, particularly as people return to work post-September. That clearly isn't happening. We're continuing to see wage hikes, particularly in the lower end. The second, I think, big cost consideration is going to be higher energy prices. It's probably not going to impact the second quarter or the third quarter earnings season, rather, but it is going to start to impact the fourth quarter and into 2022. And so how companies guide towards how they're handling higher costs is going to be the key consideration, I think, to look for.
Tony Dwyer, that's the number one issue for many people. Is it the number one issue for you?
John, aren't we a consistent bunch? That clip was hysterical. Of course, it's guidance. And of course, we have inflation. If you remember, when we tactically downgraded the market in April, not because the news was going to become poor and we had this idea that the market was going to tank. It's because the run in the cyclicals had discounted the great earnings news that was in front of it. And I think that's a story that's maybe not being talked about as much now, is that, yes, the earnings are going to have issue. Who doesn't know?
Bit of a technical issue there with Tony. Tony, we'll re-establish that. We don't want you standing still. Tony Dwyer's going to be back with us in a moment. Julian, I want to come to you. Two issues for you. We're waking up to inflation becoming a bigger issue. One. Second, we're waking up to abysmal consumer sentiment. Why are those two factors so important, and why do you think they're underappreciated still, Julian?
Well, it really ties into this entire picture of what we do expect from earnings season, John. And when you think about it, what you have here is, you're going to hear commentary about supply chain disruptions, and you're going to hear commentary about cost pressures. And the consumer sees these inflation numbers ratcheting higher every day, whether they are or are not filling up their car or buying food, which we all know they are. But the point here is, when we think about earnings season now and going forward into 2022, the question is the pent-up demand that theoretically may be there, in contravention to the very poor sentiment numbers, actually going to materialize? Or are we going to get into a situation where the concern about inflation being a more permanent part of the landscape actually holds back demand?
Well, let's talk about 22. Jamie Dimon of JP Morgan delivers earnings and says the following. This quote right here: by the end of 22, people are forecasting 4% unemployment, wages are going up, jobs are plentiful. Sonali Bassek's been pouring through these numbers. Sonali, Jamie Dimon of JP Morgan just saying it like it is from his perspective. Next year's going to be a good one.
Yeah, next year is going to be a good one. Wages, jobs, they are still a little bit worried about inflation. But with that said, they are still saying they can make money in a lot of businesses. Net interest income will start to normalize. And even with the normalization of trading, John, we've seen that drop off in fixed income. But an equities jump that more than made up for it. You've seen them jump miles from where they were just 2 years ago, meaning that JP Morgan is either gaining a lot of market share or the pool is getting a little bit bigger, or both. So, what does that mean for the days ahead? Can Bank of America and Wells Fargo show similar numbers? For JP Morgan, these advisory and investment banking numbers are just, through the roof. There's no other way to put it. More than $1 billion in every single investment banking business. It sets the bar very, very high for the rest of the peers. Though, as we know from our own league tables, JP Morgan is number 2 when it comes to mergers and acquisitions, setting Goldman up for a really nice gain, and a little behind equity underwriting when it comes to Goldman and Morgan Stanley. So there is some room to add some, money to the pie.
Stock's down about 0.6% going into the opening bell after a big rally into these numbers. Shanali, thank you. Stay close. We'll catch up again at around 9:30 Eastern time. Let's take a look at Apple. Apple down by about 0.7% in the pre-market off the back of this story from our very own Debbie Wu here at Bloomberg. Apple is likely to slash its projected iPhone 13 production targets for 21 by as many as 10 million units as prolonged chip shortages hit its flagship product. Let's have a look at how the stock has moved off the back of it. So I keep repeating this. You've got the story, and then you've got how the stock responds to the story. We're down just 0.7%. And maybe capturing the debate right now, not just for this name, but more broadly for this market, is this quote from the Apple bull, Dan Ives over at Wedbush. We view today's news as nothing more than a speed bump. Let me come back to you on this, Erin. Here's one name, a big name. It's Apple. Great demand, we assume. Struggling to meet it with supply. Can't find the chips. And yet it's a market that's quite forgiving. Does that tell you anything at all about how well priced these stories might be now?
I think in some ways it does, but you have to keep in mind with Apple, you're not going to see significant demand destruction from a delay in terms of the supply chain shortages, whereas in other companies, you potentially could see more demand destruction. And so I think the market is willing to be a little bit more forgiving, thinking that Apple has decent, control of their supply chain and will be able to sell through the products at a later date. I think the bigger challenge, though, is for companies that don't have the same brand loyalty, that don't have the same stickiness with respect to demand, are you going to start to see demand destruction? And that's really going to be the key to listen to in the third quarter earnings call to see what type of visibility corporates can provide with respect to fourth quarter and 2022 earnings.
Tony, I think this has got to be the number one question, and welcome back. I'm pleased we sorted out those technical issues. Hopefully they remain resolved. Tony, the number one question, when you've got a company like Apple for the broader market too, do you view this as profit deferred or profit lost? Which one is it?
And this is not, as you know, I can't comment on individual names, but Apple is where it was in January, which means to me that we're in the situation where the market's been a discounting mechanism. John, I think you asked a perfect question to Erin. How much of this is discounted? We know we have inflation. We know we have supply chain constraints. We know we have labor tightness. So how do you know when it's discounted in the market? And the answer to me is when you get what you fear in terms of news, and it doesn't really have an outside reaction to the stock market. You had a weaker Apple number today, or you had that story out of Bloomberg on Apple and the supply chain constraint, and you had a higher inflation story today, yet the bond yields are up just a little bit on the long end, and the futures, as I look at the Bloomberg screen, are basically flat. So that suggests that the summer of indigestion that we had, where the average stock really didn't do anything, including Apple net from early in this year, the summer of indigestion, in our view, is kind of transitioning into the year-end opportunity.
Julian Emmanuel, your thoughts on that, please.
We think there's perhaps a little bit more indigestion to go. If you look at the three drivers of higher stock prices in 2021, the Fed, clearly that has become a neutral element, and we would argue that with the overhanging risk of Chairman Powell not being renominated, if he is in fact not renominated, probably a headwind of reasonable vigor. The second being public flows. The public has been the incremental, the earnest, the constant buyer in this market for months on end. And over the last 4 or 5 weeks, what we've seen is a, sort of a blah response from the part of the public, whether it's options volumes beginning to moderate, or what we look at is the last half hour flows into the market. The market has consistently been for sale in those last critical 30 minutes when mutual funds tend to do a lot of their buying. And then, of course, the last thing is earnings. What we've seen, and this is typical for every year for the most part, except last year in the pandemic, is that earnings estimates begin to plateau and actually decline a bit now. And if you look at the correlation of earnings estimates to the market, it's been pretty robust. So our view is that until we get a little bit more clarity out of Washington, we are going to be patient in terms of buying in anticipation of a fourth quarter rally.
Erin Brown, just put a bow on it for now. We'll continue this conversation, but just a final word from you. You've reduced your overweight to equities. You've alluded to that. I want to understand what's the epicenter of it and what would you need to see to come back in?
I think we're going through an inflection point right now with respect to markets, and there's a lot of news that the market needs to digest. I don't think it's properly discounted right now into stocks. And I do think that the big question mark is going to be margins, given very lofty expectations. We started to see negative revisions to earnings. Inflation is going to start to eat away at some of the margin pressure or the margins that we see within corporates. And so I think that as we go through this sort of period of indigestion, as the market starts to discount, potentially higher costs, that is going to ultimately be the impact to sort of moderate our sort of expectations for a higher equity. So it's a little bit of a short-term view, but we do think that right now, as we look into the fourth quarter, the market is too optimistic regarding earnings expectations.
Let's build on that. Erin Brown, Tony Dwyer, Julian Emmanuel, great lineup this morning going into the opening bow. Coming up on this program, markets keeping an eye on the Fed, the transitory debate heating up.
Many supply shocks that are manifesting themselves make for a more persistent and stubborn inflation outlook.
The T word is a dirty word. That's next. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Substantial further progress standard has more than been met with regards to our price stability mandate, and as of the September meeting had all but been met with regards to our employment mandate. The committee indicated that if progress continues as expected, we judge that a moderation in the pace of our purchases might soon be warranted.
Fed Vice Chair Richard Clarida sticking with the T word. Atlanta Fed President Raphael Bostic pushing back.
It is becoming increasingly clear that the feature of this episode that has animated price pressures, mainly the intense and widespread supply chain disruptions, will not be brief. Data from multiple sources point to these lasting longer than most initially thought. And by this definition, then, the forces are not transitory.
There is clearly a divide on the FOMC. Let's bring in Bloomberg's Michael McKee for more. Morning, Mike.
Morning, John. I'm not sure these numbers today are going to make a big difference to either side because there's something for everybody. You look at the headline number, and Rich Clarida's more than met is true. It comes in stronger than expected, up 0.4 on the month, leaves us at 5.4% on a year-over-year basis. But look at the core. It comes in as expected, up 0.2 on the month, and so just up 4% on the year. It's flat. It came down the last month. So some reasonable news there in terms of the overall. Taking a look at the components of it, food and shelter, more than half of the overall increase. Rent up 0.5%. Food, not one of the biggest movers, but it is one of the ones that gets noticed the most, and it was up 1.2% in September. It's up 4.5% on the year. Gasoline up 1.2%, and that's the other one people really notice. But natural gas, I point this one out, 2.7%. It was supposed to be up, and we're going to see more and more and more of that. The so-called transitory numbers are going higher as well. The used car prices, they were down this time. Airfares were. Apparel down 1.1%. So some categories are falling off. Now, it doesn't really change anything, as I said, about the Fed. Today we get the Fed minutes, and it's expected to confirm that they were all pretty much on board with tapering. The issue is going to be, do we tighten going forward? And that's going to be the real question. When do they start that? And that's the debate that you and all of your guests are going to have now, Mike, from lunch, John. You're going to be stuck with that one.
We're going to do it right now for at least 10 minutes or so.
One bit of good news.
Go on.
For people, as senior citizens, the COLA, cost of living increase for Social Security this year, probably up 0.6. That's going to be the most since 1982.
Wow, wow. Mike, thank you. Michael McKee. As Mike points out, it's not just about the data. For many people in this market, for most people in this market, it's about how the Federal Reserve will respond to this data. Matt Lazzetti of Deutsche Bank came out with this line just yesterday. With the committee proving to be sensitive to higher than expected inflation data earlier this year, we now expect the greater persistence in these inflation dynamics to lead to liftoff in December 22. Let's have this conversation right now. We can do that with three great guests, Tony Dwyer, Erin Brown, Julian Emanuel. Erin, let's start right here. How sensitive will this Fed be to the data that is coming through the economy at the moment? I've got 2s up 2 basis points, I've got 3s up 4, and I've got a flatter curve. What say you?
So the market already is pricing in a faster pace of tightening than even yesterday. We now saw the first rate hike being priced into the market of September 2022, which is pulled forward a month, and then the next sort of rate hike in March 2023. So the market already is anticipating a faster or sort of quicker pace of tightening. I think what's going to be really key to watch is that OER number that beat expectations. It was up 0.4% after the last 3 months being about 0.3% rather. So that is a pretty sticky number. And as you start to see the stickier numbers take hold and start to really build up in terms of inflation, I think that's what's going to be the key to watch with respect to the Fed's reaction function. The reopening trades we expected to start to slow down, so seeing some pullback in those numbers with respect to the CPI inflation is not unexpected. It's those sticky numbers which we really need to watch, because that's going to be what the Fed's going to be keyed into.
I wonder if the three of you really believe that consumer expectations matter a great deal here as well. The Federal Reserve Bank in New York put out a survey of inflation expectations 1 year and 3. 1 year up to 5.3 from 5.2. The readings for the 1 year, the readings for the 3-year period of inflation expectations, the highest in the 8-year history of the reading. From your perspective, Julian, do these matter? Are they important for the Federal Reserve's next move?
They are, and part of what's been so difficult to evaluate in an environment where economic volatility, if you look at the last year and a half, now looks nothing like it has the prior 40 years, is the fact that these numbers matter for the first time in those 40 years, going back to the 1970s. And if you look at the textbooks, the two things that make inflation become from a near term to a more medium and longer term issue are wage gains and the actual expectations in themselves in the minds of the consumer. The Fed is going to be watching this very carefully.
Tony Dwyer, your take, sir.
John, I think that's why they're tapering. They have an asset purchase program that's going to be diminishing. They said from basically November through the middle of next year. This didn't do anything to change that game plan. I don't think the Fed is going to raise rates as they've said, for the foreseeable future. You know, we can come on and guess what they're going to do, but ultimately they haven't lied yet, right? And they've told us every time that they're going to move in rates. They've told us, and he was very clear. Jerome Powell was very clear that there's a big difference between asset purchase tapering and when you're going to begin to lift rates.
Pretty clear, though, Tony. They're split on 2022.
John, so here we...
Carry on, please.
Here we are. I'm sorry. Here we are. Think about this. We've got the news that was supposed to be so bad. We got the bad inflation news. We've also got a 10-year note yield that is about 20 basis points below where it was at its peak earlier this year before we had the inflation news. So again, I'm not debating whether there's inflation, whether there's margin pressures, whether there's labor issues, supply chain shortage. No, all of that is factual. What I'm challenging the market to be is, as we go into year end, has that been discounted?
Yeah, and I think that's the number one question. It's not about the data, it's about how policymakers will respond to that. And we don't know. We can have that conversation right now. Deutsche Bank thinks they will end of next year. Citi frame it in the following way. We're going to see some further upside surprises in inflation, had another mild one this morning, and central banks trying to catch up with that. We will still see more hikes being priced. Money markets in the UK today, the headline across the Bloomberg, money markets seeing the Bank of England rate at 1% in December 22. Look, 1% still very low, but from where we are at 0, that's a change. I'm looking at the yield curve. How does it absorb and take through that inflation data this morning? It's the front end through the belly where you start to see yields higher. This is a market, Aaron, that seems to be gravitating towards tighter monetary policy. And I guess my question for the three of you, Tony's laid out what he thinks. Aaron, would you be willing to fade that move?
Well, I think right now we're still seeing the market discount the expectations of rates being pulled forward. And you're seeing that in the flattening of the curve. We've seen pretty dramatic flattening of the curve really across the entire curve. But if you look at 530s as an example, the flattening there has brought that curve back down to sort of the near-time lows. So I do think that the market is still digesting the expectation for a faster or quicker pace of tightening, starting in 2022 and beyond. And so for that, as we move through sort of that adjustment in markets, in addition to the expectation of faster inflation, I think that is going to be something that is going to discount equities further. So that's why we're sort of neutral here on equities, looking to really wait for some of this news to be digested further before we step back in. I do think that cyclicals can do well in this environment. And so I would be sort of selling some of the secular longs that are, more long duration and buying some of the cyclicals that, do well in higher inflation environments. But I wouldn't be fading the move quite yet because I don't think that the market has fully discounted this expectation of higher or faster rates.
Julian, split vote on this. You get the final word.
Well, like so much in these last 5 or 6 years, John, there's politics involved here. It really comes down, in our view, to who the next Fed chair is. If it's Jay Powell, we think rates will end up being lifted at the end of next year. If it's someone else, you're likely going to see rates stay stickier for longer on the short end, and that's the recipe to getting to a 2% 10-year yield, in a discontinuous amount of time. But either way, the inflation issue is an issue, and you're either going to see it play out in the short end, the long end, or we think potentially both.
Julian, thank you, sir. Julian Emanuel sticking with us alongside Aaron Brown and Tony Dwyer. Coming up on the programme, your morning calls, and later, earnings season is underway. JP Morgan topping estimates thanks to a record quarter for deal makers. That conversation just around the corner. That stock, negative 0.2%. This is Bloomberg.
OECD nations need to end coal use by 2030. Developing nations need to follow suit by 2040. And we need coalitions of solidarity between countries that still depend heavily on coal and countries that have the financial and technical resources to support transitions, because it is essential that no more coal power plants are built.
Just a little bit of a lift going into the opening bow this morning. Good morning to you all. About 5 minutes away. Equity futures up 0.2 on the S&P. On the Nasdaq, up 5. We advance 0.57%. Call it 0.58. That's the price action. Let's get you some morning calls. We begin first up with Baird, downgrading Skyworks to neutral, forecasting slower growth due to component constraints and supply disruptions. Get used to those lines. Benchmark initiating coverage on Lionsgate with a buy rating, seeing a number of compelling growth prospects. That stock is positive 0.4. And finally, Jefferies downgrading Wayfair to a hold, expecting rising costs and supply chain headwinds to weigh on the company's top line. I said get used to it. Coming up, JP Morgan kicking off earnings season for the big banks. We'll break down the results next with Baird's David George. This is Bloomberg. From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Now you can say the trading week is properly underway. CPI behind us. Earnings season has started. JP Morgan, we'll talk about that name in just a moment. Equity futures going into the cash open this Wednesday. Positive 11, up about 1/4% on the S&P. On a Russell, up 1/10 on the NASDAQ. Up 0.6%. That's a lift, and that's the opening bell. Switch up the board and get to the bond market. The shape of things as follows for treasuries. Yields on 10s. Now lower. I can't keep up with this. Down by 2 basis points to 155.77. Where you'll find yields a little bit higher is at the front end of the yield curve. Twos pushing higher. Your 2-year yield, that's where the story's been the highest since spring of 20. In the FX market, euro dollar, euro firm is stronger, 115.64. Crude on the back foot, a break of 80, 79.70. We're down by a little more than 1 percentage point. Around the opening bell then, about 25 seconds in, we advance 1/4%. Bottom of the pile is energy, down 0.75%. The financials pretty much unchanged, but it's early days. We'll get some of those moves in just a moment. JP Morgan front and center, kicking off earnings season for the big banks with the numbers and listening to the call. Shanali Basak. Hey, Shanali.
Hey, John. You know, you have JP Morgan stock that is fluctuating this morning a little bit lower, even though it had major beats in earnings and revenue and at their major investment banking lines, especially that equities business. But you have analysts now really asking executives over and over about loan growth. They're not willing to guide into what next year looks like, though they have a bit of a positive picture on net interest income in particular. And we also have a lot of color around expenses that may come out of JP Morgan. Very, very important. They're talking about their acquisition strategy. They are talking about their ability to pay for talent at a competitive time. And you have Jamie Dimon saying that he will spend whatever they have to spend to compete with firms in this space. He name checks a firm in particular in talking about not just buy now, pay later, but the fintech companies expanding into credit. He said he will be spending to expand the retail branches abroad, as well as on potential other tack-on acquisitions, as they have done this year in many industries.
Shanali, thank you. Looking forward to the coverage today and, of course, tomorrow. The big day. We've got so many banks coming up tomorrow, Shanali. Thank you very much. JP Morgan then down by a little more than 1% in early trading to 163.64. David George Abed with us now, maintaining his neutral rating on JP after the earnings report, a 135 price target. David George with us now. David, let's start right here. That stock is up about 30% in today. As someone said to me earlier this morning, it's one of the rare parts of the market that actually got more expensive through this year. Does that explain why we're a little softer on otherwise pretty decent numbers?
Yeah, I think that's right. Good morning, John. Good to be with you. Yeah, I think the quarter was fine. There were some encouraging signs really throughout all of their major businesses, but I think the stock reaction more than anything is just a function of high expectations going into this quarter. That there's been a lot of money flows into financials, and with JP Morgan printing a good quarter at 2.5 times tangible book, we think that the stock is priced for that and indeed reflects that.
We need to do better. We need to find loan growth. Are you seeing some subtle signs that that's starting to build?
Yeah, there was some pretty encouraging commentary with respect to loan growth. That there was, I think it was 2% sequential loan growth. And part of the whole loan growth story is obviously one of the main issues that investors are focused on, especially, John, in the corporate part of the market. It's really been untold is this supply chain disruption issue is really weighing on corporate loan demand. And it's very simple. Companies cannot get inventory. And if they can't get inventory, there's no need for them to finance that inventory through lines of credit. So as supply chain disruptions start to normalize over the next several quarters, that alone, we think, will result in a step function higher in loan growth, particularly in the corporate area.
David, that final point is so underappreciated and not talked about enough, I don't think, more widely. So I'm trying to understand then, who's the best, who's optimized their setup to take advantage of that through next year? And when you look at the expansion plans at JP Morgan, 48 states now, David, I just wonder whether they're the ones that are well positioned for this, or is it others?
I think JP Morgan, as well as a lot of the large regional and money center banks, are very well positioned to benefit. JP Morgan, as you mentioned, John, is embarking on a very aggressive organic expansion plan into new markets, really going in with their retail operation. And JP Morgan is using that scale advantage that they have to spend a lot on tech as well as internal growth. They obviously do not have the ability to do any additional acquisitions due to their size and where they are in the deposit cap. But that internal growth opportunity is indeed a big one from our perspective.
David, I know you've got to run. It's always got to catch up. Busy morning for you, sir. Thanks for giving us a few minutes. David George there of Baird. This stock is negative about 1%. But as I say, coming into today, up by about 30%. Still with us, Tony Dwyer, Erin Brown, Julian Emmanuel. Julian, overweight financials, energy, healthcare, underweight discretionary, communication services. Let's do the financials piece first. Why?
Well, if you go back to the financial crisis and you look at financials as a percent of the weight in the S&P 500, even though you've had a rip-roaring year-to-date performance, it's still incredibly close to all-time lows. That alone might be a cause for being optimistic here. But in our view, again, the paradigm is different. Inflation is a concern. That to us means long-term yields are going higher in a world where we see that financial disruption, if anything, is likely to lead to more combinations. It may not be the big banks acquiring, but you can expect the landscape to flatten and get smaller through M&A into next year. And again, the tailwind of rising rates after years of being on zero, you cannot discount the benefit there enough, in our opinion, at this point.
Tony Dwyer, your take, sir.
John, it's much more important on the sector allocation versus the overall market for us right now. We do expect a year-end rally similar to like what we had in 2004 and 2010 in the second year of those recoveries following a summer of indigestion. So that would be the financials, the materials, the industrials. The industrials are about as oversold as they get on a weekly basis. And of course, the energy, although it's had a heck of a move here, I'd maybe wait for a little bit of a pullback there.
Looking at Delta Airlines off the back of the energy story, Tony, Delta's down about 3.6% in early trading. They're warning about higher fuel costs. Erin, I know you've reduced your exposure. I'm just trying to understand the cyclical parts of this market you're still constructive on. There are things we talk about every single day. You know, we started this show with Tony Dwyer joking about how seemingly everybody was on the same page, on the same issues, almost every single day. When you start to feel like you need to lean the other way?
Yeah, I mean, I think that we're sort of at that point right now with respect to markets. I think the markets very much is, you know, very long, a lot of the secular growers and has really, if you look at how the market's performed and what, you know, they've taken leadership position over the last 3 to 6 months, they've sold out a lot of the reopening trade, a lot of the cyclical risk that the market was long, as Tony mentioned, with respect to industrials, with respect to some of the hotels, leisure, airlines. And so I think that we're at that point now that you really want to look at what stocks are going to do well in a lower growth but higher inflationary environment. I think metals and materials, some industrial names will do quite well and be able to take advantage of higher prices. I also think that as the market starts to normalize, and you started to see it in the data, that you will start to see service-oriented spending increase at the expense of more durable goods. So I think some of the reopening trades like the leisure and hospitality sector will do well again. And I do think that as you see higher prices, you will start to see some demand destruction. So some of the names that have done very well in the consumer space, in the durable goods space, will start to eat away at those margins and start to underperform. And so I think that going forward, particularly as we look into the fourth quarter and early 2022, it's going to be less about the beta directionality of the market and more about individual stock picking or sector selection in order to, you know, outperform.
Let's build on the sector selection point. Tony, for those of our audience that missed the top of the hour, you made the point about the relative underperformance of energy, financials, industrials, materials versus the S&P through the summer into September. You were alluding to that point. It's in your research. Tony, can you build on that? Just add an extra layer of clarity on why that's important from your perspective about what is discounted and what is not going through this earnings season.
John, I think it's really important because it replicates what happened in 2004 and 2010. Let me really quickly go through this. We keep thinking that every cycle is unique. In my career, I've gone through 4 recessions, and subsequent bear markets, and then recoveries. Every time you go into a recession in the U.S., it comes from a different place. We had the savings and loan crisis. We had the dot-com and 9/11 crisis. We had great financial crisis and, of course, the pandemic. So it was a unique reason that we created a credit issue and a money availability issue and causing a recession. But what the consistency is, what happens after that? Every time the Fed, the government, the only course of action is to print as much money as you can. So you get this huge excess liquidity that goes into a big market rip in the first year, 2003 and 2009, of course, 2020 into early 21. Then you go into an indigestion period because the markets are so good and the recovery looks better on the excess liquidity. You're like, uh-oh, the Fed's going to start to cut back on their easing. You go into a summer of indigestion where interest rates go down like they did this summer, cyclicals underperform like they did this summer, and then you get, not that the news is going to get great into year end, but they've discounted it. And to couple with what Aaron said, I think we're at that point where the summer of underperformance in the cyclicals, the summer of lower interest rates up until recently, discounted the slowing that we're about to see from whatever the reason is, supply chain or labor.
Julian, give me the final word on this. To shorten up what Tony just said, in many ways we've seen this movie before. It won't be any different this time.
It may be different this time to a certain extent because, again, the inflation paradigm is different. If you look at core PCE, it has gone sideways for 25 years until 6 months ago. You have broken out. It is an inflation uptrend. We can debate whether it's going to be long-lasting or how it's going to wiggle. But to us, actually, we want to keep thinking about international stocks, John. They tend to be very convex to cyclicality. And in fact, when we think about the growth trajectory next year, we think there's an added bump to the rest of the world catching up to our progress in terms of containing the virus that's going to loosen up activity and cause multiples to expand.
Julian, you're killing me. I could go another 20 minutes and I'm short of time. There's 2 points there. Let's pick up on those 2 points, and that will be the final 2 points we cover with the three of you. The first point there was this is different. There's an inflation regime you need to appreciate. Tony, that question's going to go to you in a second. The second point was on regional divergence, regional allocation, regional exposure. Aaron, you get that question at the end. But Tony, first to you. That's going to be the opposing point to everything you just said, that this inflation regime could be different. What would you say back?
And current inflation is higher, but if you look at long-term inflation break-evens or the 10-year note yield, it's below where it was even near the peaks last cycle.
That was short and sweet. Tony, thank you. Aaron Brown, your take, please, on the regional exposure.
So I still like being long the U.S. relative to other markets. The reason why is, first, if you look at the energy crisis right now, it's hitting China and Europe much harder than it is in the U.S. Secondarily, if you're thinking about emerging markets, they're going to be much more sensitive to rate hikes in the U.S. than probably the U.S. market itself. So I think for those reasons, staying close to home, probably as we go through this pivot point in markets, is going to be the best bet.
Aaron Brown, thank you. Alongside Julian Emmanuel and Tony Dwyer, a perfect panel to break down earnings season as things kick off. Guys, thank you. About 12 minutes into the session, let's break down this equity market just briefly for you. The S&P 500 advancing about 0.25%. Top of the pile, materials, information technology. Bottom of the pile, energy and financials. Just want to sit on the financials for a moment. Negative 0.5%. And then quickly go to the bond market. 2s, 10s, 30s. Just a snapshot of the yield curve right now. This took place yesterday. We had a flatter curve. It's taking place again today. Up 2 basis points on 2s. On 30s, we're down by about 5 basis points. On 10s, we're down by 3. That's a flatter curve, led by the story at both ends. 2-year yield higher, 10s and 30s, those yields lower. The first 40 minutes of this program, it's not just about the data, it's about how this Federal Reserve, how central banks will respond to it. There's a feeling, in part, a feeling from a big part of this market that the central banks start to get sensitive to this incoming inflation data, that somehow this story is changing, that their tolerance for this is diminishing somewhat. And that move at the front end is something I'm super focused on. 36 basis points. Tony Dwyer and Canaccord making the argument in the last 40 minutes that maybe you want to lean the other way now. Start to lean the other way, that we've discounted too much. I've heard that from others too, but maybe you don't. And that's what makes the perfect debate right now. It's some kind of inflection point. Someone loses, someone wins. They always do. But right now, this curve is flatter yesterday and flatter again today. Coming up, choices must be made. Speaker Pelosi steering Democrats towards curbing costs in Biden's economic agenda. We'll head to Washington next. This is Bloomberg.
surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
You look
drop
great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
They're extremely thankful. They don't know what to say. Again, they can't even fathom that they're out of Afghanistan. They're still in a state of shock and can't believe it.
What we have built through this process is essentially a mechanism for getting oppressed women and girls out of Afghanistan. So we're actually going to circle up and see what resources we have left, to see what options we have left, what mechanisms we have left, and actually look at potentially trying to get more women and girls out of the country as well.
We've been through a lot, us as a team. I know sleepless nights, but you know what? There's nothing more satisfying than knowing that you've saved many lives, and will continue to support these girls on their missions.
How far will the Bloomberg surveillance team go to get the inside story?
The UK will deploy its reserve tanker fleet this afternoon.
There we go.
Tom McKean and I might be part of the reserve fleet
We might be.
that gets deployed.
This is more complex than people think. The steering wheel's on the wrong side of the truck. That's the first thing.
Oh my God.
Thank you to the gentleman out on Twitter that captured this moment.
Wait, question.
Wonderful.
Who of you has a driver's license?
You don't need that.
But the fact is that if there are fewer dollars to spend, there are choices to be made. And members have said, let's get the results that we need, but we will not diminish the transformative nature of what it is.
Speaker Pelosi says we have to make choices. Congressional Progressive Caucus Chair Pramila Jayapal saying the following: if we have to cut the numbers slightly, then we would reduce the number of years, because the universality of the benefits and the immediacy of the benefits is absolutely critical. For more, Bloomberg's Anne-Marie Horton joins us now in D.C. Morning, Anne-Marie.
Good morning, John. The narrative clearly moving away from that top line figure that was really driving the debate. Now that they know it's going to cost around $2 trillion, what do you fill it with? And Speaker Pelosi saying tough choices have to be made. This is very similar to what she wrote, John, in her Dear Colleagues letter, saying that overwhelmingly what she is hearing is that they should do fewer things but do it well. And that really a little bit goes against what the progressives want. The progressives still want to make sure that most of Biden's agenda is in there, even if they have to shorten the timeline. So this is really going to be the debate over the next few weeks. This week, though, the House and the Senate are out of session, except, of course, for last night to avoid that financial catastrophe. They voted on the debt ceiling. But next week, when they are back in Washington, this is going to really be driving the debate.
Anne-Marie, did you notice some frustration from Speaker Pelosi there? There was a question that was asked from CBS. Do you think you need to do a better job at messaging? And she replied by saying, I think you need to do a better job at selling it, to be very frank with you. That's a sign of real frustration here. It's not the reporter's job to sell the plan for them.
It's not. It is the administration's job to sell the plan, and we have seen the president go around the country and try to do that, and it's for his leadership team. That's Speaker Pelosi, and that's Leader Schumer in the Senate. The issue the Democratic Party has, John, is the fact that it is just vastly wide at the moment. You have many progressives that are just pushing for all of it. They had a huge victory. Then the fact that they are not going to vote on hard infrastructure until they get that reconciliation package. And then you have the ones very moderate down the middle, like nothing can be able to get done until Senator Joe Manchin and Kyrsten Sinema sign up for it. So this is what the leadership is battling. It's this fractious party that they are dealing with, and they have to at some point acquiesce a number of individuals to get this over the finish line. This is why she is saying tough choices have to be made because time is running out, and they're trying to get this done by October 31st. But we should note that is not exactly a firm deadline. That for the transportation legislation that runs out and that funding that runs out could then be extended for another 30 days, which is what they did prior.
And to be clear here, Anne-Marie, I don't see any institutions, media organizations, including this one, turning down an interview with the administration or Speaker Pelosi, congressional leadership, Senator Schumer. Welcome on the show anytime. Anne-Marie, quickly, just a timeline. Do we have a timeline right now? What is the timeline?
Well, Speaker Pelosi has outlined that they will vote, that she wants this to be done by October 31st on Halloween, John, and that is because that transportation funding I was talking about for highways and these workers that could get furloughed, that runs out at that time, and they put that funding into the hard infrastructure package. So just vote on the both bills at that point, then you don't have to extend it. But what they can do, and they've done in the past, is just extend it. But clearly, having these timelines and having these dates and these deadlines set up by Speaker Pelosi is helping move the momentum and push the party towards what she says making these hard decisions.
AMH down in D.C., Anne-Marie Hordern, our Washington correspondent. Anne-Marie, thank you. Thank you very much. We are negative on the S&P, just by 0.06%. On the NASDAQ, we're positive by 0.4%. With the sector price action, here's our stocks editor, Dave Wilson. Hey, Dave.
Hey, John. Yeah, you've got 6 of the 11 main industry groups in the S&P 500 lower in early trading. Energy stocks leading the way down, along with those financial companies. The results out of J.P. Morgan not going over well, and you're seeing declines tied into that. And let's not forget, airlines are in the industrial category within the S&P 500, and the results out of Delta. The idea that the company is anticipating a loss this quarter, thanks to higher fuel prices, after a profit last quarter. That stock's down, and it's weighing on the industrial group. In terms of what's higher, I mean, you've got the raw material producers and also technology companies. And that's the interesting part, because late yesterday, you might, or early today, you might not have seen that happen given, what we reported with Apple cutting production of its iPhones this quarter because they can't get enough chips. And so we've seen Apple suppliers come down. To some extent, that's countered by Qualcomm, which plans $10 billion in stock buybacks. But when you put it all together, I mean, this is a group, if you look at the SOX index of semiconductor stocks, Philadelphia Semiconductor Index to be more precise, set a record in mid-September. It's pulled back. It's kind of bounced around its 200-day moving average, a gauge of price trends. And it's moving up today because we're seeing gains in Qualcomm and most of the rest of the group, even as Apple suppliers take a bit of a hit here.
Dave, thank you. And thanks for picking up on the Apple story and the broader semi story as well. Apple break at 140, 139.85. We're now down almost 11% from the September 7th high. Following our story here at Bloomberg, that stock only down by 1.15%. I say only, it just gives you an idea of how much we've been talking about this over the last month or so, the last month for much of this year. The bond market is interesting. I'll keep building on this for you. The front end is selling off yield to higher by 2 or 3 basis points to about 36. Yield to lower on 10s, on 30s. It's a flatter curve over the last couple of days. Coming up, the trading diary, that's next. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.